Back to business, right? We've managed to outdo the rest of the world. We've sustained a bounce for 2 days. Now, whether this is a bounce that gets sold into or it's a sustained recovery is what we will, today, I guess, will determine that in trade. But implied Nifty is trading flat, but I guess global cues mixed. I think the handover from Wall Street wasn't bad, but Asia is muted.
Yeah, so the global cues are mixed, definitely. Let's start with what the US market, was looking like overnight. The 2 bits of inflation data become very, very important. What we'll see on Wednesday, later this evening, and on Thursday as well, because this is the last cut of inflation data before the Fed meet. So, which is why all eyes on that. Tech stocks did rebound, so that was good. Your Nvidias, etc., did come back into focus. The August CPI data will now become key, and Thursday you will have the Producers' Price Index, so that also becomes important. Bond yields actually moved lower ahead of that data. As you saw the 10-year at 3.64. But I think the big story overnight was crude and the kind of collapse in crude prices. Now, this has happened for a few reasons. Mainly, OPEC has put out its expectations of what they see demand doing in terms of crude, and they've actually lowered it than their previous forecast. So they expect demand to grow by 2 million barrels per day in 2024. That's 80,000 barrels per day slower than what they thought before. Even for the next year, for 2025, they see demand growth at 1.7 million barrels per day, which is 40,000 barrels per day lower than what they first expected. So they've tamped down expectations on what demand is going to be. The China slump still continues. And now add that with the output increase, which will come in December. So hence you've seen crude prices come down. A bit of recovery now after the markets have opened again. So that's why you're seeing the NYMEX up there. But the Brent still under $70. Asia continuing to be weak despite that uptick in tech prices on Wall Street, but Asia weak. South Korea had good unemployment data coming in, the lowest since they've started that gauge. Japan's producer sentiment data was a little weak, and that's why you're seeing the Nikkei also down in the red. So the handover from there is a bit difficult. I'm just going to pull up the implied open for the Nifty very quickly to see where we are at. I mean, I'm seeing completely flat right now. And just to look at fund flows before we get to Santosh Rao for his take on all things global. So you had buys yesterday, and remember you saw a pretty good boost in the second half of the trading day. So some of that perhaps coming from foreign investors, 2,208 crores coming in from them, while domestic investors were net sellers at 275 crores. But let's get a sense of what are going to be the big factors, because the news flow is coming inwards, I would say, for the next few days. And Santosh Rao, head of research partner at Manhattan Venture Partners, is with us this morning. Mr. Rao, great to have you on NDTV Profit and speak with you.
Great to be here.
Yeah.
Absolutely.
I'm sure you've been glued to the debate, so I'm going to start with that. It's been a very, very tight race if you look at the polls so far, almost a photo finish between Trump and Harris. Do you think those scales are tilting post the debate?
I was listening to the debate. I just cut off. It's still going on. This debate was as expected. There's a little bit of you said, she said kind of thing going on. I think Trump kind of was okay, was more constrained. She held her own, so that's a good sign. So I don't think this will decide anything. They both stake their claim there. It'll be down the road now. The last stretch, the home stretches, which will decide what's going on. But at this point, there are different the ratings are different in terms of the economy and the immigration and few other, which are important things right now, the livelihood, the cost of living and all that. I think Trump wins outright. He's going to reduce taxes and all those things, and that's very business friendly. She's more on the social side. She says she's going to do everything that pretty much what Trump is going to do. She's going to reverse what Biden was doing. So I think she still has to claim that nobody knows what she's doing yet, but I think she'll expand on that. This debate was a good start for her, but I think down the road. So I would say it's still 50-50 with a slight edge to Trump at this point, just given the importance of immigration and the economy at this point of the cycle.
Santosh, hi, good morning. It's also Samina joining in. So we've got no major triggers apart from, of course, elections. And the big one, that's the Fed rate cut, which some may argue is already priced into the markets. Over the next 4 to 6 weeks, do you feel like it's going to be a directional trade for global equity markets or for risk on? And maybe there'll be opportunities where the markets may see dips, which could potentially get bought into.
Yeah, I mean, I can talk about the US. Yes, the 25 basis points is priced in. But we saw today, JP Morgan, the CEO, talked about how the banking sector took a hit. They're saying the consumer, the customer is slowing down. The credit card debts are up, margins are down. So the banks, the financials took a big hit. So definitely air of slowdown is in the move towards slowdown is definitely happening. So the only issue now is 25 basis now. He can't do 50 because that's going to send too many alarm signals. He's going to do 25. The next issue is whether it's going to be 100 basis points for the full year. That is like 25. 75 left. So 25, 25, 25. So is that going to happen, or is just going to do 25, 50 and 25? So we don't know what combination of that. He's going to be data dependent. So, but I think keeping in mind, he's already said that the inflation is not an issue. It's on a glide path to 2%, his target. So he's not worried about inflation. It's really the labor market that he's worried about. If things really slow down and if layoffs pick up and things like that, I think that's going to be an issue. So still at this point, it's going to be, I'm in the camp of safe landing. And I think that's where it's heading right now. I think so. If that happens, we're fine. We'll just ride out this one, and then I think it'll go up. But as the interest rates come down, I think that's great for the emerging markets, for the outflows. I mean, India especially going to see a lot of outflows. The dollar weakening, that helps the emerging markets. So all those things are net positive for the emerging markets and other areas. But US, I think a slowdown, a soft landing is what we're looking for. So net, everyone will be happy if we have a soft landing. But let's wait and see. There's a geopolitical tension going on. Oil prices are down. That's reflecting that. So all those things are playing into this also. So a lot of cross currents at this point looks like.
Did I hear you say India is going to see a lot of outflows?
No, inflows to
okay,
you.
Fine. Okay, great. Yeah.
The dollar weakening and interest rates coming down, it's going to help you out there and other emerging markets.
Perfect.
So
one more question. Do you reckon this crude price fall, and independent of whether it's at 69, 70 or 75, but at those levels, it's indicative of recessionary winds. A normal price fall is welcome. This is indicative of some bit of demand concerns. Is that still a big net positive for emerging markets, oil importing emerging markets like India? Or would you reckon recessionary fears far outweigh the gains from a crude price fall?
Yeah, I think that's not clear yet. I think talk of recession is picking up, especially after today, what JP Morgan said and what the CEO said, that the consumer is who was holding up the economy. I think through all this turmoil, the consumer was still buying, though he was going down the value chain, but he was still buying. That was holding up. The job market was still holding up. But I think if we start seeing cracks in that area, I think recession will pick up. But at this point, there is no talk of recession. We are definitely slowing down. How much slowdown is a big issue at this point. Let's wait and see. The CPI data coming out tomorrow, I think that's going to, hopefully that's not a hot number, and that will continue the glide path down to 2%. But it's really the jobs number, which will come be after the Fed meeting, and then before the following Fed meeting, we'll see where that goes. But at this point, things look like the pillars are still holding on, though they're wobbling here and there, but they're still holding on pretty well. The oil prices is a tax on the people. If oil prices, well, right now it's good, it's beneficial, it's coming down, but we want it to come down for the right reason, not because the recessionary fears and all that. Right now there's oversupply, the demand is slow. China is really the culprit there because they have slowed down. So that's what's happening here in the US. That's still okay.
Santosh, just a quick one. Basic economics. We saw that when Alan Greenspan did it. We saw when Bernanke did it, and now, of course, Fed chief. It's you give a rate cut or you talk about a rate cut when an economy is slowing down. We've known this all along. What suddenly changed 5 days ago is what I can't get my head around. Earnings largely for Wall Street companies have beaten street expectations. So why are we suddenly waking up and smelling the coffee. Is this, because in my opinion, I just feel like we've bought into this rumor for so long now that maybe it's time to take profits off the table, which is healthy investing and trading, you'd imagine, right?
Yes, it's time to take it off, but it's still a stock picker's market. You have to be selectively going into different areas. I would continue. You saw Oracle's numbers; they're still great. So the old world, old tech is doing very well. The new tech is kind of selectively doing well. So yeah, take profits as needed. But I think the reason we need to bring down, if I understand your question right, the reason the rates need to come down is the gap between their neutral rate, which is roughly around, I think, 2.8 to 3%, and what the Fed funds rate is at 5.25. That's a big gap. That deficit, that increase, I think he needs to close that, and he can afford to close that. That's more, he doesn't need to be restrictive now. The economy is restrictive enough. That was his big issue. So he needs to bring it down, but bring it down slowly to a normal level. And he'll do that. And meanwhile, it's a stock picker's market. You just go in. AI is still at play. Cloud is still at play. So I would just go in there. I mean, like you said, the earnings are good. They're projected to be good, though there's slight slowdown. So I would stay in the market, definitely. And 60-40 is the back in play. You can make money in the bond market as well, selectively. You can make money in the stock market. So it's all around. It's good news. Not a bad news yet. But let's see what the dark clouds, will they just pass out, or will they cause some happiness?
You're right, Santosh. Markets usually ahead of the real economy, so we will see where we go in the next couple of months. But thank you for joining us this morning. A quick check on implied Nifty before I do a quick recap of what happened in trade, and of course then we'll set up trade for you today. It's a flat start, so don't expect too much, but we will open above levels of 25,000, and I think that's comforting for a whole lot of bulls on the street. Well, it was 2 days of gains coming in for the Nifty. The Nifty ended the day about the crucial 25,000 mark in trade. Resistance was very obvious at levels of 25,150. We made an intraday high of 25,130, and at that level is when selling emerged, and the markets ended 90 points lower from the day's high point. Broader markets staged an outperformance after Monday's sell-off. So the recovery came in from the place which sold off the most in Monday's trade. Buying was also resumed very visibly back in IT stocks. The IT index was up 2% after the initial profit taking that was seen last week. IT made a pretty smart recovery in trade. Pharma stocks continued to see buying interest largely on back of the passage of the Biosecure Act in the US House of Representatives and the GST cuts on cancer drugs. So pharma as well was the second big gainer in trade yesterday. Remember, it was the weekly expiry of Financial Service Index yesterday, which kept Bank Nifty up and about, and the key talking point in yesterday's market action. Today as well, it will be all eyes on Bank Nifty because it's the weekly expiry on Nifty Bank. Stocks like Premier Energies have had such a strong run since its listing. It's been 9 straight days of gains. What we saw yesterday was the very first day of the stock giving up some of its gains post its recent listing. Inox Wind and Paytm were the other big ones that gained on 2 crore volumes, which is way higher than the 1 week average that these counters have seen. And apart from that, it was ONGC and Oil India that continued to reel under pressure on back of lower crude prices. OMCs that are the usual beneficiaries of lower crude haven't been participating in the last few days, but what we've seen is action across paint, lubricant and tire companies responding well to lower crude prices. So that's been the setup. There was a bounce back. Now, whether we sustain this, whether it's real, whether it's here to stay, in my opinion, today will be the deciding day.
Just one mention for Piramal Pharma yesterday, because this is something that we were tracking on the close, and you should pull up the intraday chart. The kind of upswing that we saw, I'm not sure if it's because of the Biosecure Act or what other reason, but that's
has to be that.
Yeah, I mean, it just last 5-6 minutes of trade, suddenly you had a spike in Piramal and Pharma. I mean, I would be interested in seeing also whether that theme continues for the Pharma pack across today, and at least some of those CDMO players.
Yeah. I mean, Piramal was up 3-4% and then a big spike, as Tamanna said. So very interesting. So, anyways, what does the trade setup today look like very quickly before we get to stocks? So the index looks like somehow it will continue to consolidate with a positive bias for now, because while lower oil prices are positive, it's just that the nature of the fall and the reasons behind the fall are usually not conducive. I mean, recessionary winds not quite conducive there from a sentiment perspective. But remember, this whole recessionary conversation is running into a Fed rate cut cycle. Even if it's 25 basis points right now and then commentary around more, that should be construed positively. I don't think there are clear answers to this, to be honest. I don't think too many people can give. Yesterday, met a couple of very smart money managers, big watchers of the power sector for a really long time. People are taking money off the table when it comes to power. So if you're trading there, please be careful. Some real smart money and not just the money manager variety is now taking money off the table on power. It's something to focus on and look at the valuation. So keep that in mind. Somehow the safest bets not just from a day's perspective really seem to be OMCs and pharma has already done its bit. OMCs have done one leg of a very small run up, but watch out. Could be very interesting in the times to come.
I'd like to watch banks as well today. It's your weekly bank expiry, so I think there could be some focus one way or the other. It's an important sort of sector to track, especially in the current market conditions. Very quickly, what were FI flows like? Were they buying, selling?
They were buying yesterday. FI flows yesterday were actually positive, and maybe we pulled that up earlier, but let's just do a quick recap. They actually came in and bought yesterday significantly in the sense relative to what we've seen in most of this month so far. So 2,208 crores. It was DIIs who were net sellers. So maybe that moved some of the mood up as well.
Yeah, so you've had the buying coming in from foreign participation. Let's not forget that it's been a busy week for the IPO market. So there is some liquidity that some may argue, is squeezing out or coming out of the secondary markets and going into these primary markets as investors, local and global, seek value in our markets. A bunch of stocks, just to add to Niraj's list of OMCs being in focus. I still continue to remain and believe that the big beneficiaries beyond OMCs really is the companies and sectors where crude is a significant raw material. We caught up with CIAT yesterday and they said if crude remains lower, you will see a significant impact of that on their margins on the upside. So you want to keep a track. They may not move intraday in that sense, but if crude remains lower, paints become a really good buy. They've already recorded record highs very recently. Tire companies become also good investment opportunities. Along with that, small ancillaries also stand to gain. So I'd even add fertilizers actually to that list of sectors to watch in trade. Let's take you through stock-specific action. Corporate news flow today is relatively slow as compared to what we've seen over the last few days. A few stocks that I have on my radar. We'll start with CESC because, in my opinion, we may not know the size of this, but it could be a stock mover to some extent. It was already up 5% yesterday. Markets may have had a whiff of this, but we believe the arm Purva Green Power has accepted LOA from CESC for setting up a 300 megawatt solar PV power project. So with this approval, this company stands to gain significantly. The stock already went home with gains of 4.5%. Let's see if there's follow-on buying coming in on the stock. Another one which was in the news was yesterday was IRB Infra. They've had a really smart toll collection, a strong uptake in the month of August versus the previous month, a year-on-year increase of 20% as well. Stock was okay, but this morning there's a little bit of negative news on IRB Infra. And this is because there will be no toll to be charged for traveling up to 20 kilometers on highways and expressways per day. Toll collection for over 20 kilometers will be based on distance covered by the vehicle as per satellite data. This could impact the toll collection or the revenue number that comes in for IRB Infra. Markets may be a little disappointed. The stock.
My only point on that is how easily is this going to be implementable? This
satellite data.
The reason they're doing this is because wherever you have those toll booths, people who live around it need to pay toll just to cross maybe 1 kilometer across.
So the cutoff's 20 kilometers in that case, right?
Yeah, but how are you going to track it? Satellite data.
And how do you know who lives close by and who doesn't?
I think there's going to be longer lines at the toll naka till they sort this out.
No, and also the time when management has said that the festive season will only do well for this company, right? Because a lot more travel also does pick up. Now, like Tamanna said, this is not an easily executable plan that's been put out. Maybe you may not see a big reaction on IRB Infra, but over the course of time, I would imagine that there should be an impact on tolls.
So one way to actually do this, just thinking out loud very quickly, not getting into the semantics, we now have FASTag.
Yeah.
The FASTag deducts the money when I get into a parking lot. Let's say I cross the car from a booth, from a toll, 20 kilometers after that
when it starts ticking in.
When there is another FASTag detection center which sees that the car had crossed and therefore the money is deducted. Now technology can hopefully allow us to do a few
You know
things.
how many cars are still there on the cash line?
No, you can
Outside
always
body?
argue
Yeah,
that
there's
there are
one
problems,
step
but I'm
in the
saying
right
there are
direction.
steps.
It will take time.
But 20
yeah.
kilometers is a pretty large distance, so there will be an impact on the counter in that sense. Another one, Inox India, is worth mentioning. We don't know yet the size of this market, but they've got their patent for cryogenic liquid-based variable temperature cold storage unit. The stock should be responding positively to that on back of this patent.
Okay, first stock on my radar is Tata Motors. Tata Motors in the news after they announced some price cuts on their EV models yesterday. Shailesh Chandra, by the way, is now the president of the association, SIAM, as well. But the reason that I'm talking about Tata Motors today is a UBS note on it, which is a fairly negative note. They've retained a sell call, and their 12-month target for Tata Motors is 825 rupees. So a downside of about 20%. The reason is, first of all, they think that the stock has run up a fair bit already. The sharp discount which has been given for Range Rover Sports is one of the big reasons that UBS cites for their call. They say the extended successful run of models which have been doing well has started to moderate. The order book is now below pre-COVID levels. Rising discounts, moderating growth, and a lack of any new ICE or hybrid launches could result in a significantly weaker financials for FY26. They also think that commercial vehicle demand is wobbling and PVs have started underperforming peer growth. And this is something that we heard time and again from the big event in Delhi yesterday, where you had everyone from the industry come in. The valuations is also a concern they have. For JLR, it's 7 times PE. For the commercial vehicle and PV segments, it's at 10 times and 14 times 1 year forward EV to EBITDA. So a combination of these two factors could see a bit of a pain for Tata Motors. The other set is actually Premier Explosives and Astro Microwave, because they have an MOU with each other. Now, defense deals are starting to pick up again, and you could see some action in both. Both companies have signed an MOU for a strategic alliance. They will develop and sell multiple products jointly. They've not given details of which products, how much, etc., but that's typical of companies in the defense space. So let me tell you about Premier Explosives. It's engaged in manufacturing of industrial explosives and detonators, and its order book is at 889 crores as of June of this year. Astro Microwave, meanwhile, is in design, development and manufacturing of subsystems for radio frequency with an order book of 2,365 crores. So since we've already seen a fair run-up in, I think, a week or so with the bigger defense names, you might see some action here. Lemon Tree is the other one. I mean, on a complete signing spree. And the latest one is in Mumbai, in Mira Road, actually. It's a 108-room property expected to open in FY 2026. They already have 5 existing properties in Mumbai, so this is one addition. They've recently signed in Nasik. They've co-signed 3 new management and franchise contracts in this quarter, in quarter 1 actually alone. And as of June 2024, there are 107 operational hotels. They've done Ayodhya, also a whole host of signings. So I'd watch out for Lemon Tree as well.
I'll watch out for OMCs for sure. Oil prices at the lowest level since 2021. I remember the MK note on the 4th of September, wherein they said that the most obvious and the most powerful investment hypothesis is on oil marketing companies, and they believe that they expected OMC earnings to blow out over the next couple of quarters. Remember, thus far, no pricing action taken by the government on lowering oil prices. So this quarter earnings will certainly benefit, because the better part of the month of September and some part of August has benefited from these lower oil prices for the oil marketing company earnings. So
just very quickly on this, Niraj, then why haven't they reacted? Have you got
there is a bit of a reaction that has happened because HPCL has rallied about 12-13%.
Even before the crude price had started falling.
Yeah, so some bit of it has happened, but it'll be interesting to see whether there is more in store. I think that's the 1 month chart, about 11% for HPCL. But let's see if there is more in store. The other one is ONGC, and I thought the Nuvama note was very interesting. We'll go very quickly because I think we have a guest waiting, but Nuvama has come out with a note on ONGC. They retained the reduced rating with a target price of 232. The lines are very strong. They are saying that earnings are poised for a free fall as the USD $75 per barrel crude threshold has breached. And they say the market exuberance for ONGC contradicts the missed production targets. They say the company has repeatedly missed guidance, and only 18% of the street is bearish, which indicates excessive exuberance. So that was a very interesting note, I thought. And I watch out for ICICI Lombard. We'll talk about it in detail. But Citi has initiated a 90-day downside catalyst watch. The target price is 1575, which is a 29.4% downside. We'll talk about the details of this in a bit. But watch out for this one as well. I'm sure our colleagues will highlight these in greater detail a bit later on. But I think the important other conversation to do, guys, is FMCG, and is this the return of sentiment and earnings both for the staples companies? Deputy VP Research at Sher Khan at BNP Paribas, Kaustubh Pawaskar, with us on the show today. Kaustubh, good having you. Thanks for joining in this early in the morning. Just trying to understand, Kaustubh, what are you telling your clients when it comes to the FMCG names? Is there rural demand recovery? Is there cost pressure easing? Is there sentiment changing around the staple names?
Certainly. So in quarter one, we have seen rural demand outpacing urban demand, and that helped most of the FMCG companies to see a sequential recovery in the volume growth in quarter one. I think this trend will continue. We have seen monsoons to be good, well spread out. We should expect agri production to be better. And that further augurs well for the FMCG companies. In fact, even government has also put in a lot of efforts to improve the rural sentiment. So I think overall we should expect this momentum to continue. Rural demand will continue to improve and will be much better in the quarters ahead. We should expect urban demand to be quite stable, and overall the volume growth should improve in the coming quarters. We are expecting H2 to be much better than H1 in terms of the revenue growth. Whatever the pricing deflationary scenario was there, I think it is almost over now, and we should expect revenue growth to be in line with volume growth. So overall, we should expect second half to be much better. In terms of cost pressure, I think we have seen raw material prices seeing some bit of uptick. But they are quite stable. Crude, we have seen falling below $75 per barrel, so it augurs well for the paint companies and other FMCG companies. I think in terms of gross margins, we should expect gross margins to be slightly better or stable on YY basis. Even the EBITDA margin should be, slightly flat or, on a better side on year-on-year basis. We should not expect a significant jump in terms of margins. But in terms of revenue growth, we should expect, revenue growth to be much better compared to what it was in, H1.
Kaustubh, we get your point. The second half of the year is when you will see this rural recovery, impact earnings as well. How much of this do you think is already in the price? Because for the last 6 to 8 weeks, we've seen a solid run-up across consumption names, right? So some may argue it was on back of earnings. Others believe it's a great defensive play in a market such as this. Do you think valuations are comfortable, and how are these stocks stacking up on the risk-reward basis? And what are your top stocks in the sector to play rural consumption at current valuations?
So we have always remained selective in this space because, there are certain stocks which have not done well in past 2 to 3 years. For example, Hindustan Unilever, if you compare its valuation to last 5 years average, it is still at a discount. And we have seen that, and we believe that once rural recovery is there, HUL will be one of the key beneficiary in terms of, recovery in the volume growth. We have seen its market share gain, product portfolio has remained high, and that will continue. But if rural recovery is on track, I think that should benefit HUL, and we should expect, a company to post good performance. The important factor for Unilever is now, HUL is that it is focusing on its core business of, home care, personal care, and, food and refreshment. And, the innovations and the premiumization is happening around these 3 key pillars for the company. So I think we should expect HUL near-term and medium-term performance to be much better. And in terms of margins, also we should expect gradual recovery in the margins in the coming years, with premiumization remaining core of the strategy. So we believe that HUL is one stock in the large cap space, large cap FMCG space, which will continue to do well. Britannia is the another stock which we believe that there is a fair bit of space left, because we have seen Britannia's volume growth to be better compared to industry growth. The rural is coming back on track. Britannia is focusing on the Hindi speaking belt, where it is expecting growth to be much faster compared to its other markets. It is also focusing on launching new products in its basket, and overall we believe that Britannia should definitely do well. In the large to mid cap space, we believe that Dabur is one stock which should do well, with rural coming back on track. Godrej Consumer Product, we have seen the company is doing exceptionally well for its India business. We have seen some of its strategies playing well, and that should continue to happen. Emami is the another stock which we believe that valuations are still looks conducive for the investment, and I think again the rural play will definitely well for Emami. In some of these small stocks, we have seen small companies performing much better than large companies for past 4 to 6 quarters, and some of these companies look very good in terms of valuation, such as Jyoti Labs or Varun Beverages, where the earning growth would be better than the large companies, but also in terms of valuation, they looks to be much better if we compare to some of the large peers. So these are some of the stocks which we believe that will do well. ITC is one of the preferred pick, mainly because of its discounted valuation, and also its core cigarette and FMCG business is doing well. So I think that should continue to inch up the valuation for ITC in the coming quarters as well.
Okay, Kaustav, just a call on the retail side of it and a bit on the discretionary play as well. Trend, Aditya Birla, some of your gold sort of plays. Are you seeing that buzz continue there, or do you think the time for staples has come?
See, in retail, again, I will prefer the value fashion space, because that is something which is seeing a good growth. So trend, we have already seen clocking good numbers. It's especially its Zudio is doing exceptionally well in tier 2, tier 3 towns. Similarly, there are other companies such as V2 Retail, which is again a value fashion space, where we have seen its same store sales growth growing in strong double digits. Is average revenues per square feet is consistently improving for past 6 quarters, and they have certain targets where this revenues will continue to improve along with the profitability. So strong earning growth is expected in B2 retail. Valuations at around 14-15 times FY26 EV by EBITDA is much better compared to its peer. And I think if it continues to post good numbers at operational level, I think B2 retail valuation will continue to further improve.
So much, Kaustav. We'd love to chat further, because this is a space which might see a kind of a rotational play as well. Kaustav Pavaskar there on his top picks in the FMCG space, but bank expiry today. And that's going to be an important day from an F&O perspective as well, Samina.
It will be, Tamanna. Yesterday as well was a financial services expiry, and on back of that, banks were largely in focus, and we did see them stage a fairly good participation in terms of trade. What we have this morning is a little bit of an unsure market. It's going to be a bit of a tug of war between the bulls and the bears. The Nifty 50 is trading a September futures trade in a premium, but there's very clearly a decline in OI that we are seeing. which really means that what you're seeing is there is a little bit of short covering that's happening, but again, tough to call whether this is sort of how far the short covering could take the index. On the Bank Nifty side, again, very similar picture. September futures have seen a premium, OI has seen a decline. This largely means that you are seeing a short covering led gain in the market. It's not fresh long positions that are being initiated. What the traders have done is that over the last few days when the Nifty had corrected, the anticipation was that there could be more pressure. But because we defied that and started moving higher, traders began to cover their shorts and the markets managed to go up slightly. So that's what we have in terms of the F&O picture. A quick check on the OI distribution, and if you can see, 25,000 is a very interesting level, and this is where maximum calls have been written and maximum puts have been written. So while it acts as an important level of resistance for some traders, it also becomes an important level of support on the Nifty. That, of course, is followed by 24,900, 24,800. Those are the next few levels of support that bulls will be met with if they initiate fresh long. So what you're watching out for is 24,600 on the index, which will provide a base for trade. That, of course, is followed by 24,800 and then 24,900. But 25,000 is the most important level of support, and call writing also seen on those levels. On the upside, you've got 25,500 maximum call OI, which largely means that this is it's far out, but becomes a very important level of resistance if you're initiating long trades. So you might like to see the index go to those levels, but those could be tough levels for traders to take out. Before we hit that level, of course, you've got 25,100, which got tested in trade yesterday, followed by 25,200. So it's an interesting market. It's a little bit of a bounce back. Whether or not it's a sustainable rally is going to be anybody's guess, because what you've seen on the Nifty and Bank Nifty is short covering so far. So until fresh longs don't come into the Nifty and Bank Nifty, the rally may not be sustainable. So you want to be slightly more mindful about that when you're initiating trading positions. On the trade side, on the stock side, what we've seen is counters like DVs, Atul, Syngene. I mean, look at this. This is largely coming in from the pharma pack. India Mart have all seen long built up. PFC, this was knocked out in trade on Monday, continued to see some action in the session yesterday, but there's been short built up. So pressure on some of these PSUs continues, or PSCs continues in that sense. Granules, Tata Power, Dabur had a similar picture. So you saw massive decline in OI. Prices have also moved up. So again, these are sectors of stocks where you've seen some short covering, indicating that there could be some more way to go, even though the upside could largely be capped. So that's what we have. It's a healthy, it's a okayish setup, nothing that we can get too excited about. Today is going to be important. Whether that short covering rally converts into fresh longs is what will determine the direction over the next couple of days. But we have with us Akshay Bhagwat, Senior VP of GM Financial, now joining in. Akshay, good morning. Thank you for joining us. It's a very difficult market to read and trade, right? We've seen small gains come in on Monday. We saw that again on Tuesday. But the recent recovery of sort is short covering led. What do fresh positions, or should traders initiate fresh longs or shorts on the Nifty? And of course, you've also got Bank Nifty expiry today. What does one do?
Good morning, Samina. So, well, it's a choppy phase, as I understand, in the market in the current situation. And one of the classic way to look at it would be the options data, because if you look at the 25,000 strike, if both the weekly as well as the monthly options, significant open interest is built at a single strike. This just means that the option writers are building short straddle strategies, which is selling calls and puts of the same strike, that is 25,000. So when you do this, you play for a choppy market. A range which is possibly set is 24,800 on the lower end and 25,300 on the upper end. So I am expecting directionless trades within this broader range of the market. If you want to micro time this, then probably at this current rate, we should wait for a dips, possibly around 24,900 is another buying opportunity you might get on the trading side. And you need to take an exit in case the market recovers recovers near 25,200 to 250 zone. So play this choppy phase, buy support, sell resistance is what the advice is for the Nifty index. And for the bank index, today is the weekly expiry for the bank index, and expecting some bit of volatility there because yesterday was a very quiet session for the bank index. The broader open interest positioning for today's expiry is 51,000. That's an important support because a lot of put writing have been set up at 51,000 strikes. If you get those dips of 51,000, 50,900, that's a good opportunity to go long for today's weekly expiry. Do not see much of a downside in bank index for today's or for the short term, and a recovery should see bank index moving for the levels of 51,700 on the upside.
Right. Akshay, you seem to have a constructive call on Cipla, but you're doing it through a rather hedge strategy. So it's not a naked long trade, but you're buying calls. You want to walk our viewers through what the strategy is on Cipla. And for traders who do not understand how to trade options, would you still recommend going long futures of Cipla?
Well, see, first of all, the setup in the pharma space is very strong. Cipla is one stock which has been kind of trading around its support zone, and I'm expecting momentum to regain. So my broader target, which I look forward in the short-term space, is around 1680 to 1700. Now, the whole idea is to trade via options to play out this bullish move, where I would recommend buying a vanilla call option of the September expiry of the 1640 strike. So by buying an option call, you are limiting your risk to only the option premium you pay, which is around 26 odd rupees in the current case. In case Cipla moves as per the expected direction, which I'm assuming 1680 plus, then an option premium should target around 39 to 45 on the upside. And as a risk management, you can keep a stop loss of 18 on this option premium. So roughly going by the lot size, your profit potential would be around 9,700, and the risk in this strategy should be 5,200.
I believe you're equally constructive with, of course, limited euphoria on emphasis. For the September series, what are you doing here? I believe you're buying calls. You want to elaborate on that strategy, the upside, and, of course, the downside risk too?
Yes, so we have seen a very strong up move in the IT space, and we believe there is still more room to go on the upside. So emphasis is our top bet in the given situation. 3080 is where it closed, and I have a bullish view targeting levels of 3250 for the September month. But here I am constructing a bull call spread where I'm recommending to go long on a 3050 in the money call, which is roughly available at a premium of 103. You bring down your cost of buying the call by selling a deep OTM call of the strike 3150, which traded around 57 yesterday. So it's a moderately bullish view, which I am expecting in emphasis. And as the stock moves up, you will make profit on this strategy. I'm expecting levels of 3200 plus, as I mentioned. And roughly the profit potential I look forward in this strategy is around 8,200. And you can work with a stop loss of around 4,700 on this strategy.
Well, that's the word coming in, Akshay. Thank you for that. It's going to be consolidated. It's going to be choppy, but constructive calls on pharma. Cipla, Akshay's got a long trade on where you're buying calls. By doing that, you're limiting the downside and, of course, trading it on a cautious ground. He also has the same trading strategy on emphasis. But, of course, if you do not understand how to trade the option market, both these counters are available on the future side. You can initiate fresh long trades on that too. With that, Tamanna, it's back to you.
All right. So Bank Nifty expiry is going to be in focus today, and really the big mover that we need to watch out for. Meanwhile, focus on autos as well. UBS has retained a sell rating on Tata Motors with a target of 825 rupees. Now, Tata Motors has been in the crosshairs or so after their discounts on EVs was announced yesterday as well. Puneet, let's talk a bit about why UBS has come out with this 825 rupee target price.
Well, definitely, this is a 20% downside from the current market levels. And as you rightly said, the India business has seen discounts, and UBS is now expecting that, JLR as well as Land Rover will have potentially discounts to, pump up the growth going forward as well. And that's what's a concern for the company. That's what they expect. Now, they are saying that, Range Rover Sports sharp discount spike in July has been one of the key things to watch out for, because the demand environment has been relatively stable. So coming out of the blue has been one of the key questions that they have and they're raising in this particular report. These models have, had a very successful run over the last 4 years, and UBS thinks that going forward, with JLR's EV transition coming next year, in this particular year, they might have to rely on, pricing strategies to get back some of the growth that might have tapered off in the last year. They also said that the order book is also now below the pre-COVID levels, and for the first time in the last 4 years. That's another key concern that they're highlighting, and mentioning that, the average selling prices of these cars, such as the Defender and the Sport, had gone up by roughly 49% in the last 3 to 4 years. So going forward, they will have to employ these discounting strategies going ahead. They see a material rise. They also potentially are seeing a material rise in Range Rover Sport discounts in July, and are seeing that the near-term deliveries might be affected because of one of the suppliers for aluminum has their plants flooded due to bad weather. So that's also one of the key things that the management also highlighted in the Q1 con call. Finally, they are seeing that rising discounts as well as moderating growth might be one of the key things. And that's also a view that HSBC had a couple of days ago, where they mentioned that discounts of valuation versus Porsche is roughly around 50% now. So JLR business is one of the positives going forward over the last couple of years, and that's also seeing to be on wobbly ground. So that's going to be one of the things to watch out for in trade today. Back to you.
The other story, not a great day for auto even globally, Puneet, because BMW, I believe, has come out with guidance cuts worldwide, and important from Indian market perspective also because of the number of listed players that supply to BMW.
Well, definitely, Europe essentially is getting into a shaking ground. We have seen, talks on Volkswagen also, shutting one of their plants down essentially, and they are right now bound by an agreement that they can't do that. So roughly around 3 lakh jobs might be affected because of that. But right now we're looking at BMW. They had the investor presentation released yesterday, and it's not a very pretty picture on the numbers and the guidance that the company is given for 2024. Specifically, they expect the EBIT margin guidance for the automotive business specifically to be around 6 to 7%, and for context, this was around roughly 10.8% reported in 2023. The other thing, they're expecting deliveries also of cars to be slightly below the last year's level, and mentioning that for 2024 on a group PBT level specifically is also decreasing significantly. They haven't given a quantification on this, but that's another negative to watch out for. Capex ratio has increased, and so has the R&D ratio to sales, and that's another thing to watch out for. Finally, they're expecting the free cash flow for the automotive business to come in around 4 billion euros versus roughly 6.9 billion euros in the same time last year, and also saying that the share buyback program for another 2 billion euros might be, they will have to evaluate that going forward as well. So that's one of the key negatives here, because both Mercedes as well as BMW are the key suppliers for Indian automakers who are exporting their products there. While we have seen certain companies call out their agreements with BMW, such as ZF Commercial, which is listed on the exchange, as well as Force Motors, there are a few others that might have not called it out but are very big suppliers in Europe. So, for example, Motherson Sumi is a very big supplier of Mercedes. Roughly 20% of the export sales come from them, but they are also slightly supplying to the likes of BMW as well. Apart from that, the likes of CIAT also supply to their tire makers going forward. Uno Minda is another key category that we look at. One of the other suppliers, they don't call out the client specific ratio what it currently is on exports, but it may be other than some of the other ones who are very big in Europe specifically are Endurance Tech as well as CIE Automotive listed on the space. So these auto ancillaries might have a difficult picture for exports going forward. For tire makers, they've already called out that Europe this year might be a difficult transition. So slightly negative. Let's see how the stock reacts. Back to you.
Absolutely. Just to recap that list, and you mentioned some of those, and this is, the Bloomberg sort of list of suppliers to BMW. So, Samvardhan Motherson, CIAT, Tata Steel, Apollo Tyres, Uno Minda, JBM Auto, some of them. I'll go a little slower. Endurance Tech, Minda Corp, CIAT, CIE Automotive, Ricoh, and Rane Brake. So you could see some impact. I mean, I reckon it is the world over you are seeing this. So I don't know if you're going to see a massive impact today on these auto anch companies. Might be more of a domestic story.
Yeah, but the words are very stiff, wherein they are saying that it's a significant downtick on guidance and significant decrease, etc. So Could be very interesting to see if this happens. There are a lot of disruptions happening today, guys.
Why do you think that's happening? Do you think it's actually a drop in demand and a weaker economy, or is it because of EV?
I'm guessing has to be as a slowdown,
A mix of both. Okay.
slowdown in demand across.
Yeah.
We know Europe has been
It's
reeling under
tough.
pressure for a really long time relative to the US as well. So not surprised that this is happening. Plus, maybe EVs as well. I think.
Well, let's not forget
Chinese
countries like
EVs,
India.
are
Step
much
out of our
cheaper.
office and see the number of BMWs. So developing markets are probably not as bad.
Yeah,
So
but
rest
I mean,
of
I
the-
don't know if, like I said, I think some of the EV makers are making a big dent. So which is why Europe had to
Restrict
make
imports
those
from
restrict
China.
the imports from
Yeah,
China.
China EV.
And China's found a way around that as well because they're setting up shops in some of the other countries
By being
wherein
a
there is
holdco, yeah.
no issue. So, this is turning out to be quite a thing
It's
for
the
European
new
car
world.
makers. It's
Old
the new
industry
world.
is. We talked about this yesterday, right? I mean, look at just different comparables, but traditional retail versus quick commerce. These are loss-making companies that have stretched valuations. But I think the old school is still going back to companies like a BMW versus a Tesla or BMW versus an EV. But yeah, I think it's time for change.
It depends on how quickly some of these giants can change as well. But yeah, that definitely gets added to the stocks that you need to watch today when markets open. But we'll add some more. And here's what's on NDTV Profits watch list. CESC, they have a LOA for a 300 megawatt solar PV power project. Inox India has a patent for a cryogenic storage unit. Lemon Tree has inked a deal for a 108-room property in Mumbai. Premier has an MOU with Astromicro for a JV, so both companies actually there. And there are a whole set of companies which will be impacted by the sharp crude price fall overnight. I mean, not an exact immediate impact to their bottom line, but sentimentally, definitely. OMCs are in that category. Paint companies are also in that category.
Well, just to add to the list of stocks to watch, this is on the sell side. IRB becomes an important one. While it had a significant toll collection in the month of August, the current rule states that tolls will only be collected after the first 20 kilometers. So it's a negative news flow on IRB. Tata Motors could be bad news. UBS is at 25% downside on the counter. ONGC is well on our radar. Beyond weak oil prices, Nuvama is also negative on the company. And Page Industries will be hit hard on back of Reliance Retail's JV with Delta Galil.
Okay, well, let's get in our experts on the show today to try and understand what to do in a scenario like this. Kush Bora on the technicals, Vijay Chopra of Enoch Ventures on the fundamentals, Chandan Taparia of MOFSL on the derivative side. Gentlemen, all three of you, thanks for joining in. Chandan, I'll start off with you. Good morning. How are you reading into trade today? We are looking a lot more resilient, but what trades can one initiate in the session today?
Good morning. Thanks for having me. So we have seen decent recovery in last two trading session led by recovery in the global market. Nifty recovered from 24,750 to 25,130 marks and managed to close about 25,000 zone. But again, it will take the cues as per the global sentiment. But the good part is that the stock specific action is visible in the market and slow and steady. The index will again head towards the new lifetime high territory. If I look at the data setup, the put call ratio of Nifty again moved up above one level. Volatility index is below 14 marks. So the data setup with put writing activity indicate that bullish bias could continue, but we have to go with positive to range bound distance in the market. So as of now, immediate support for index goes at 24,850. Until it holds the immediate support of 24,850, index has potential to reclaim 25,333 marks, that is the lifetime high. Now looking at the stock wise, first trade I'll suggest to go with Bharti Airtel. After the profit booking decline of last 7 trading sessions, the stock has formed a strong bullish candle on the daily scale. Major trend is positive and every small decline on the daily scale is being bought. The stock has delivered the gain of more than 50% in this calendar year and moving upwards on month basis. So Bharti could be one trading idea with support of 1545. We can target towards 1625 to 1645 level. Second stock, that is buy on Indian Hotel. We have seen that selective consumption names are doing well in this market scenario. And Indian Hotel is one of the strongest names which has given a fresh breakout led by open interest activity and rising trading volume. So one can go long with support of 682. And we are expecting Indian Hotel to scale up till 730 bucks.
Okay. Indian Hotels at 730 rupees. Kush, good morning. Let's start with your picks.
Hi, morning, Tamanna. Yeah, couple of them, both of them on the buy side. We've got PI Industries from the chemical space that has been doing rather well for itself. The stocks, broken above the near-term resistance of 4650 and closed above that. So we're looking at targets of 4850 and 5000 on the upside. 4550 is the stop loss. IndiaMart Intermesh, this stock continues to consolidate, but with a positive bias. The volumes are also seeing an uptick. So I think on the from the near-term perspective, 3190, 3250 are the targets to look at. 3060 is where you place your stop loss. So PI Industries and IndiaMart Intermesh.
Okay. Well, Kush, we'll take in your index view in a bit because we need to slip into a break right now. So, gentlemen, stay on. We'll be right back with the pre-open session and some of the active stocks to be discussed with our guests. Stay tuned.
Back, you're watching India Market Open. Implied Nifty is indicating to a flat to slightly higher start. Bank Nifty weekly, it's moved into negative territory now. So while we were trading marginally higher in the first hour of this morning's show, implied Nifty now getting closer to 9 o'clock is indicating to a lower start in today's session. Well, the good news is for the macros of our country, crude prices are lower, but the fact still remains we're lacking direction, and a lack of triggers is what's keeping the markets in consolidation mode. Vijay, good morning. Thanks for joining in. Vijay, do you feel like the bounce over the last 2 days can be sustained? Is it a meaningful recovery or will it get sold into today? Vijay, you're on mute.
Extremely sorry. Thanks for having me on the show.
I think the markets are nervous, prior to the Federal Reserve meet on 17th and 18th. And globally, all the markets are waiting for the outcome. I was listening to the, auto sales numbers, which are declining across the world, which is definitely worrisome. So what I understand, from being a student of economics, that whenever auto sales numbers fall, then there is, definitely something to worry about. Secondly, we have a festive season in place. So maybe, in India specifically, where seemingly the slowdown fears are not that high as in US or in Europe, probably I think that we should wait for a quarter or so and wait for the numbers post Diwali. So that would give a clearer picture whether we are actually declining as an economy or, it's just a, blip on the radar. So overall, I would say that, markets can inch up to maybe 25,400, 25,300, 400, and there would be a stiff resistance there. There are no reasons for the markets to go up until we see a significant cut in the rate, in the interest rates. So if US cuts interest rates, probably RBI would follow that, and we are going to see that in India as well. So that would be a good news for interest rate sensitive sectors. But as of now, I think for the next 1 week, volatility is here to stay.
It is volatile, and that's not taking that away. It seems like a start at 25,000, though, may not be too bad for the street. Chandan, I want to just revisit some of your calls from last week as well. I know you were constructive. You've talked about Bharti, and it's interesting because across the board over the last 2 days, most technical analysts have got a constructive call on Bharti. But I did notice that I think it was last week when you also liked some of those consumption names, the likes of an ITC and HUL. How do you feel about these counters? Do you feel the up move could continue into this week as well?
Yeah, so somehow the consumption theme is doing well even after the market volatility. And we have noticed that Nifty FMCG index is again hitting to the new lifetime high territory. Nifty FMCG is up by around 2.5% in this week and has been making high top, high bottom at the lifetime high territory. So positive move could be there. I can talk about a stock like Marico, or can talk about Dabur, ITC, HUL. Most of these stocks are likely to be in focus. If you look at the ITC, however, a small decline happened during the week, but again, smart recovery was visible on the chart. So with support of 503, it can head towards 535 level. For new trading ideas, I believe the counter like HUL could be on radar. However, yesterday it witnessed a small decline, but that is a buying opportunity. With support of 2830, one can look for an upside target towards 3100 in HUL. So positive on most of the consumption and FMCG name, and I believe these stocks can see the lower beta and higher alpha in this market scenario.
Okay, first rates opening up right now, and we'll wait for them to settle. Of course, it's just been a minute or so, but let's look at what is buzzing in very, very early trade. In pre-open, Endurance having a pretty good day despite that BMW news, about 5% up. Piramal Pharma looking like it's going to be buzzing today as well. Remember, we talked about the sharp spike that came in right before markets shut. Your broader healthcare space also in focus because Narayana Hridayalaya, KIMS, Vijaya Diagnostic, all of them, Sirma, SGS, Global Health, a lot of these companies actually buzzing. The crude check, let's do that as well. HPCL up 2% in pre-open right now. Let's see what BPCL is also doing. And of course, ONGC, Oil India and ONGC is something that we should do a quick check on as well. IOC up 1.5%, ONGC not massively down right now. And this is, of course, the pre-open session. But let me come to you, Kush, on ONGC specifically. ONGC, Oil India, do you expect any moves here? And let me add the OMCs as well.
Well, so I think a lot of impetus, or rather focus has gone on the the OMC side of things, but I don't think we've had that kind of traction just yet in a lot of these names. While there could be some more follow through, these moves haven't really been as sustainable. So I think from a trading perspective, an HPCL, perhaps you could wait out for some more time, let it come close to the 410, 415 kind of support zones, and then perhaps consider a re-entry. But again, remember, these are these short, sharp trading bets that you consider. As far as ONGC goes, well, on its way down, firmly. Even yesterday's closing was near the low point of the day. So, this down move could perhaps continue for some time. You're looking at a 288, perhaps even a 280 kind of levels. If this down move continues, that's where a strong support zone comes in. So I wouldn't perhaps go out and buy, just yet. Perhaps closer to 280, 85, if it does show any kind of support zone and, a rebound from there is when you consider a buy on ONGC. At the moment, I think this downward move could persist for some time.
Just want to address Tata Motors as well and see what's happening there. Remember, UBS sell call, 825 is the target price UBS sees, though in 12 months. Not a big bashing, but it is looking like it could be one of the top losers on the Nifty today. SBI Life also seeing another day of pain, but then that insurance story continues and that pain continues. But Chandan, can I come to you on Tata Motors and what you see for the stock after anyway looking at a bit of a hit yesterday as well?
Yeah, so in auto space, we are more comfortable in Bajaj Auto rather than talking about Tata Motors. Looking at the Tata Motors on 29th of August, it witnessed a decent recovery from 1066 to 1142. But after that, it has been making lower top, lower bottom and trading well below its 50-day exponential moving average. So because of that, some more decline could be there. I believe 1000 or 990 could be the major support where the recent profit booking may get arrested. So let it decline towards 990, 980 zone, and near to those level one can go for buying attempt. But if looking for positive bias, then Bajaj Auto could be one name where some sort of strength could be seen. It has negated the profit booking of last 4-5 days. With support of 10,700, Bajaj Auto has potential to rally towards 11,400 marks.
Well, that's the view coming in on Bajaj Auto, the stock expecting a flat start. Chandan, anything that you're cherry picking in the IT pack where it seems like there could be gains rolling in? I did notice that Wipro did a decent catch up in trade yesterday, interestingly.
Yeah, so if you look at the Nifty IT, we are quite bullish in the entire Nifty IT, and as per the relative rotation graph, IT, FMCG and pharma could lead the entire market. First, to reply on Wipro, overall it has been moving in a broader range from last 13-14 days with multiple support at 510. It finds hurdle at 540 zone. So 510 to 540 is the range. One can buy on decline with support of 510 for higher target. But Coforge could be one name which we like most of the time. Technically on the weekly chart, it completed a bullish price pattern which is similar to a cup and handle pattern. It has given as it has surpassed a supply trend line and formed a positive price pattern, and because of that, up move could be there. However, this is one of the strongest counter, but we believe this strength could continue with support of 6650. Coforge has potential to rally to a 7200 zone.
Well, gentlemen, stay with us. It's expected to be a muted sort of start as we gear up for trade this morning. The Nifty indicating, a pre-open indicating to a very, very flat start as we get set for trade today. Well, it's 9:05 and as always, time to take our brokerage note for the day. Harsh, what's on your list today?
Good morning, Samina. You're seeing negative catalyst watch from Citi on ICICI Lombard, 30% downside from here. They're cautious with regard to growth. They believe that some bit of a headwind from the auto sector also might likely impact growth numbers for Lombard, which largely does or rather specializes in motor, now getting into health. Now on the health side as well, they believe claims will likely keep pressure with regard to where the P&L is concerned, and therefore they believe higher claims, especially from the group segment where Lombard has grown well in FY24, will start to come through, which they believe will impact the numbers going forward. Last off, with regard to changes on the OPEX front, as Lombard continues to scale, they believe that OPEX to income largely has remained steady. They've not been able to bring that down in a meaningful or significant fashion, which also continues to, in some way weigh in on the financials. And that, coupled with rich valuations, they believe is going to keep the stock under pressure. Well, they're expecting target price being 1575, a 30% downside from your 90-day negative catalyst watch, which they've opened up on this counter.
Okay, Harsh, thanks so much for putting this into perspective. This is, I say Lombard 0.5% higher right now, but watch out for that because the rationale that Citi seems to have given is very, very potent in terms of the internals that ICICI Lombard is working with, the target price notwithstanding. By the way, ICICI Lombard features in a list of yet another brokerage today because Jefferies put out an updated list of stocks that they like and don't like. And Jefferies, the fresh inclusion to buy list, has ICICI Lombard within that. It also has Coal India, which has replaced Hindalco, or Siemens, which has replaced HAL, and a bunch of other stocks, of course. But ICICI Lombard stands out there too. A lot of mention of FMCG as well. So that's the list of stocks that you want to watch out for from a Jefferies perspective, but ICICI Lombard features there. Vijay Chopra, fundamentally, how do you look at an ICICI Lombard? Is that a business that you would want to buy in and stay with the stock for the 12-month period, or would you stay on the sidelines?
I think that, when the stocks move up, there is likely, that some correction might, set in. And I've been talking about the same, I think, even on your shows that, get out of high beta, get into lower beta stocks. The stocks which have moved up are giving good profits. Profit booking is also a part of the bull market. And people generally don't tend to, do that. They get greedy. So I think that, it's a great company. So first of all, no need to panic. Generally, with so many noise all around, investors tend to get confused and, they think that markets are here to make money in the short term. So in the shorter term, probably this stock might come down maybe around, say, 1900, 1950 odd. But again, it would be a good buy in the longer run. We have to understand fundamentally that India is a grossly underinsured country, whether it's general insurance or life insurance. Now, people are waking up to the realities, that they need to have insurance. And general insurance, even corporates, but some of the banks have made it mandatory, so they do it. But there are scores and millions of, corporates who don't even go for a group mediclaim, or they don't even take a fire or a burglary insurance. So this is the state of affairs with most of the SMEs and most of the lower rung companies. So I think that no need to panic. It might correct further. For the longer term investors, stay invested. So, but yes, today is not the day where I would jump in and buy. I would rather be very, very choosy on the stocks which I buy right now. These stocks have to be very strong, low beta, high growth companies. And definitely ICICI GI, it's not a bad company at all. It's just a phase and it will pass. And then probably, once it corrects, we might re-enter and, ride the tide.
Vijay, you said today is not the day to jump in and buy. You would be cautious. What would you, maybe not jump in, but cautiously buy in the market right now? I mean, your pre-open rates have also pretty much settled, and you're getting a sense that this is going to be a range-bound kind of market. More focus on pharma once again, Piramal, Jubilant, Pharmova, all of those doing fairly well relatively. Would you bite at any of those?
Well, Tamanna, there are a couple of stocks which I'm looking into right now. CRISIL, which is the largest, credit rating company in the world, S&P company. I think that CRISIL is a good buy at these levels. One can, start nibbling into CRISIL. There's another company which is into consulting, Excelia Solutions. Excelia also looks very good on the charts as well as fundamentally it's very good. There are 2-3 companies in the IT space. Now, especially small cap, mid cap IT is... well set and also a conservative sector. So Happiest Mind, which had corrected very sharply. I think Happiest Mind is one company which I like, and R Systems. So R Systems is another company which I think can do well. Better to stay with conservative sectors. As you said, pharma is one, IT is another, and, the likes of CRISIL, which are, high growth companies, but low beta. Very strong fundamentals. So let's stay with fundamentally very strong stories.
Chandan, very quickly, the last few days, despite lower crude prices, OMCs have not participated. Do you think today is the day we could expect a catch up on an HPCL, BPCL? Could there be good trading opportunities, even intraday actually?
Yeah, so I believe HPCL could see up move because it has nature to move up and then witness decline and again next leg of rally. So after hitting the high of 457, it corrected in last 3 days with multiple support at 420. So I believe the previous day low of 420 or 417 could act as a key level. And with that support, it can again attempt to 444 to 450 zone.
So that's HPCL. In fact, pre-open is indicating to a slightly higher start this morning. Chandan rather constructive, picks HPCL versus BPCL for trade in terms of long positions. Remember, crude has declined over the last couple of days. The outlook's been negative, but OMCs have found it hard to play catch up and react. In the early days, I still remember you'd see an impact on crude prices and an immediate impact on OMCs. I believe that situation a little more complex as we see it in today's day and time. Fertilizers also looking good for exactly the same reason. I'd imagine paint companies also should be reacting to this. Deepak Fertilizer is flat, so nothing happening on that stock. Take a look at Berger and Asian. Asian is marginally higher, and Thai companies also will be in focus for more reasons than one today. Berger is up about 1%. We'll be connecting with the management very soon to get a sense of what the outlook is and what percentage of their raw material actually gets impacted by movement in crude and petchem. Well, Kush, very quickly, 1 minute to go. One stock for the day.
Shriram Pistons, a very good move on the back of good volumes. I think the next level on this one is 2,500, and on the downside, you're looking at 20-50, 20-70 kind of zones as a support.
Shriram Pistons, okay. And Chandan, is HPCL your top trading idea, or is there some other stock which is your top trading idea today? Very quickly, 20 seconds.
Yeah, HPCL is there, but I would like to name TBZ. TBZ looks good. Gems and jewelry stocks can see positive momentum. So with support of 263, I believe 300 kind of levels could be seen in this counter.
Wow. Okay. So TBZ is Chandan Taparia's top trading idea today. And Kush Bora speaks about Shriram Pistons, which had this 5% up move in trade yesterday. Let's see how the markets are starting off. Remember, Asia was looking wobbly. We are flat, absolutely flat. The beauty of the Indian markets, low beta, doesn't fall as much when the other markets fall. It's okay if it doesn't rise too much because it's risen quite a bit already. Banks about 0.25% lower. Mid caps and small caps, which were very active yesterday, should come up on your screen next. Margin in the green for the mid cap index. That is some strength. Small caps too. Not bad really. Let's get the heat map up on the screen. See what's moving and what's not. More red than green. Tata Motors, the top draw, and no surprise here. The UBS note, yes, but the fact that BMW is also cutting guidance because of inventory buildup, etc., impacts JLR. ONGC corrects a little bit. HDFC Life and SBI, HDFC Life rather from yesterday, but SBI Life too. Interestingly, Divi's takes a bit of a backseat after a really strong move and being the top gainer yesterday. So that's as far as the losers go. ONGC stands out for me for sure, but also the likes of Tata Motors. What's gaining? BPCL up a couple of percentage points. Asian Paints, so crude beneficiaries out there. Bajaj Auto, I think there is a note that I read today which said that two-wheelers could do well even if four-wheelers don't. NTPC, Infi, TCS, so taking off from yesterday. The tech names as well. So crude beneficiaries gaining, rather the crude price fall beneficiaries gaining, vice versa happening to ONGC, and Tata Motors standing out like a sore thumb today.
And expected for all the reasons that we talked about. Tata Motors in a bit of trouble, and you'll see that through the day. I just want to see what the broader indices are doing on an otherwise fairly flat and range-bound day. And up in the green on the Nifty mid-cap, but barely so, just about 40 points. And small-cap index also completely flat, so stock-specific kind of a day. We've seen some of the crude story coming in, but let's play it out and see what's happening in the broader market as well. Niraj addressed ONGC, but let's pull up an Oil India. So you have ONGC, Oil India on the other side, so negative as expected. Oil India nearly 3% down. Let's look at what BPCL, HPCL, IOC are doing this morning, and as expected on the positive side. So those expected reactions definitely coming in. On the paint side, an Indigo, Berger, Asian Paints, let's just pull up some of those counters. All up in the green, biggest gains on Asian Paints right now. The other factor, of course, is the pharma story, which has continued at least into the pre-open session. So Biocon, Syngene, Piramal Pharma. Let's see what's happening there. Syngene seeing a bit of profit booking after a good run up for a couple of sessions, but Piramal Pharma continues strong after a 6% upside during closing yesterday. Biocon also up in the green. Vodafone and Indus Tower both in focus, perhaps for different reasons. Vodafone, KMB has, Kumar Mangalam Birla has bought 1.86 crore shares. And Indus Towers got an upgrade from JP Morgan to an overweight stance. It set a target price of 500 rupees for the 433 rupees stock. So Indus Tower also showing an exciting morning. Just one last I'll call out is a Jubilant Pharmova. So they had a US FDA inspection at one of their plants, and what's worked for them is that there was nothing major that came out of it. A voluntary action was indicated. That means they just need to fix a few things, which they will likely do. So seen as a positive by the street. But no major movers that I could spot in the first few minutes, Samina.
Oh, it's rather quiet actually, and even your biggest gainer is limited to early single-digit gains. So you're not seeing very wild swings either. Remember, yesterday was a day when broader markets recovered after the recent sell-off. So what you would be expecting is stocks to see specific trading action in today's session. Well, your top counter of the day is Suzlon, which is up 4.5%. You've also got Sona BLW not doing too badly in trade, 3.5% up move on Sona BLW. Lemon Tree on back of that hotel plan in Mumbai is up 2.5%. JSW, some of your pharma names are still doing well. Paints, as expected, are having a good morning. Zomato is up about 1.5%. Paytm, after a very big move yesterday, is trading flat. Let's take a look at Premier Energies as well. Yesterday was the first day of a correction after 9 straight days of gains post-listing. The counter is down 2.5%. So the selling continues on Premier Energies. Well, the few other ones that I want to highlight is Raymond Lifestyle. It's been your top loser now for the last 4 days since the first day of a very strong listing. Selling is abating or trying to. It's not hit lower circuit at the get-go. The stock is down 3.5%. Well, from the look of it, it's not looking too exciting. Trade is rather muted. Piramal Pharma as your biggest gain. Great Eastern Shipping is looking good. Logistics cost may come down, lower crude. Who knows what the dynamics of that space are. But Piramal Pharma also seeing a 4% cut. On the 4% gain, pardon me. On the losing side, Tamo is down 4%. Raymond, I've already highlighted for you. You've also got cuts coming in for Samvardhan Motherson. It's one company that will be impacted as BMW reviews its guidance downward. Ether Industries is seeing a % cut. Insurance continues to see weakness. Stocks like Bikaji. So all your namkeen counters that gained on a GST price cut yesterday are seeing some losses in trade. All in all, not too exciting a morning to say the least. Holding steady on the Nifty, but it's only a matter of time that a direction move will be seen on the index, which could be a few minutes from now. Chandan, what are you making of the opening? It's as flat as it could get. We've got Bank Nifty, weekly Bank Nifty expiry today. What direction are you expecting the Nifty and Bank Nifty to move in today?
So again, the range bound bias is there, but the good part is that index is holding well above 25,000 marks. I believe 24,850 to 25,250, 333 is going to be the probable range, and buy on decline could continue. The good part is that crude beneficiary names are doing well in the market, whether you talk about Asian Paint or some oil marketing company. I can look at the Indigo as well, which has been forming a positive price pattern, and I think this trigger can give the positive spike to the counter. It has been consolidating a range from last 10 days with multiple support at 4,700. So now with higher support of 4,750, one can look for an upside.
A very quick follow-up, Chandan. If 25,000 gets taken out anytime now, would it be wise to initiate shorts on the index or not worth taking that chance?
No, I don't think there is a short chance. As of now, 24,850 to 25,200 is the trading band. In this band, the stance is buy on decline. Till the 24,800 or 850 is not broken, I don't think we need to change the stance. But the good part is if it manages to hold 25,000, then there will be positive stance more than the negative stance. So overall range bound, but we will go with buy on decline in the market rather than changing the stance as of now.
Okay. Well, OMC starting off, the problem this morning is there for Tata Motors for sure, because that stock has certainly pulled back very, very swiftly. So OMCs are doing okay. Tata Motors is not. 4.5% lower for this one, 992 and counting. Now, if India is the stronger suit versus the world, but if Tata Motors is an Indian auto company having a larger exposure to the global markets, then that would possibly be the weaker of the four-wheeler players between the three or four that exist. Vijay, if you had Tata Motors in your... Actually, Kush, I'll come to you first for a quick trade here. 4% down already. Would you trade it more?
No, not yet. And the reason being that, 975, 980 is a medium-term support zone, has been for a good part of this year. And, we're approaching that. So on the short side, the risk-reward ratio from here on may not be as favorable. And, a very firm support comes in at 940, which is the 200-day moving average. So while the bias is on the downside at the moment, closer to support zones, you wouldn't want to really go short on this one. So look out for 970, 975 kind of levels, on the downside. As a support zone, immediate support zone.
If you had Tata Motors, would you omit it off your portfolio or stay put? Vijay Chopra, that question is for you.
I recommended Tata Motors at 250, and this was on most of the TV channels. And I think in a lot of my portfolios, it is still there. The reason is because Tata gives you a blend of all the kind of vehicles, from the smaller ones to the larger ones, to cars, to an international market, to JLR. And I was also one of the people who said that, there's no point if the traders are into it, around 1100, 1150, I said that they might book profits because it has moved quite sharply. But yes, I'm a long-term believer in Tata Motors. The company has turned around completely. And I think probably we might see lower levels in Tata Motors, maybe 940 or maybe even 900. But long-term players, no need to panic. It will come back. But the short-term ones, I think that, hold your horses as of now. Don't ride this stock. Wait for the correction to stop. I think that if at all you get this stock around maybe 930, 940, it would be a great level to enter. But yes, I'm a strong believer. It is one of the strongest players in the Indian automobile sector and the largest player in the EV space as well. So this might be a temporary, blip. There was an announcement from Nitin Gadkari that Honorable Minister, he said that we might shift to BS7 very soon. So all the auto majors, they are they're in a tizzy because they need to change a lot of stuff from going from BS6 to BS7. It's a big toll on the auto companies. So that's one of the reasons also, we are seeing some kind of a correction in most of the auto companies. So yes, as of now, hold on. I think that if you get this stock around 940, it would be a good buy for the longer term.
Okay, so Tata Motors, obviously one of the top pain points today, but I want to get a call, and I'll come to you, Kush, on Suzlon. I mean, that's a stock that just doesn't seem to quit. Even Sona BLW, by the way, doing pretty well. But let's focus on Suzlon for a bit. A whole host of news flows, but news flow or no news flow, this definitely seems to be a big pit. Even at a time when there are concerns about the whole space and whether valuations have run up. On the charts, are you liking Suzlon?
Yes, I am. Yesterday there was a toss-up between Inox Wind and Suzlon, and Inox Wind made the cut there. Today, firmly above the 20-day moving average. The only challenge being that it is locked in the upper circuit, so you won't get an entry today. But on the whole, after a brief, corrective phase, a consolidation phase, the stocks resumed its uptrend. Yesterday, continuation today. So I think this stock can perhaps from here on move to levels of 90 as well. If you've got an existing position, continue to hold. If you do get any kind of a dip, or the upper circuit free sort of opens up, then not a bad idea to buy some. Here, the risk reward ratio will also be favorable because the stop loss comes in at about 77 kind of levels. So on the upside, for a target of 90, around the stop loss of 77, so not a bad buy from a momentum perspective here.
Paytm to that as well. So a big move yesterday on fairly large volume. So not as a trading idea, but in terms of activity, that stock also saw a move coming on very, very high volumes. Chandan, anything else that you've spotted since the markets have opened up? Anywhere that you're seeing an opportunity, either on the long or short side or on the index?
So looking at the stock specific, the index has been moving in a range and the follow-up is missing, and that's why very few counters are holding the gains. But again, positive on the consumptions, as mentioned, a few gems and jewelry names, few oil marketing company. So if I need to find out one only trade, then I can look at the trend now. Looking at the consumption theme, this stock has been consolidating in a range from last 10 days, and I believe small follow-up could see the fresh leg of rally. And the good part is it's a low beta counter, so downside is restricted, and a small follow-up could lead it to the next leg of rally. So trend could be the one trade where I can recommend with support of 7050. It can head towards 7550 to 7600. So.
Okay, what else is buzzing this morning? You're seeing Fortis Health doing fairly well. You have BSE also spiking up. Indus Towers is the other one. I'm not sure, Kush, if you gave your view on Indus Towers.
No, I didn't. But from the looks of it, I think there is definitely a positive bias on this one. I mean, there is consolidation, but the bias remains positive as you see the slope or the inclination of the averages moving higher. Now, while there is resistance around that 450 to 455 kind of zones, this is firmly at the support zone. So I think not a bad idea to consider a long trade on Indus Towers, where your stop loss comes in at close to 422 kind of levels. And as I said, on the upside, you're looking at a 450 and 460 kind of targets as an upside. The momentum is missing, so you might not get this move, let's say, in a day or two, perhaps even a week. But if you're willing to hold on positionally for, let's say, the September expiry, then perhaps Indus Towers is one trade that you can consider on the risk-reward ratio perspective.
Okay, so that's the story with Indus Tower. Chandan, let's just get your take on Bharti Hexaware also, and we'll get that note up in a bit from JP Morgan, which has seen it as one of its top calls. But Bharti Hexaware, Vodafone, Indus, that whole telecom story, we've seen Bharti Airtel also buzzing a fair bit. Do you see a further up move there?
Yeah, so in morning discussion, we have given buy on Bharti for an upside target towards 1645. And to reply on Bharti Hexa, the stock has been moving in a positive to range bound manner. The good part is that from last 6 months, it has been making higher top, higher bottom, and supports are gradually shifting higher. If I look at the weekly setup, the multiple supports are visible, and it has been holding well above its rising trend line. So trend is positive, and that's why we'll suggest to buy this small decline. Immediate basis, it has supported 1210, and with the support of 1210, I believe it can head towards 1280 to 1300 zone.
And Kushbora, paint companies, Asian Paints is higher today, some of the others. Maybe we've spoken about them, but we're just about to talk to Berger Paints, just trying to think how the setup looking.
Niraj, very encouraging. All of these companies have had a good run, in the recent past. Berger Paints also is looking at, a golden crossover of the 50 and the 200-day moving average. The volumes are a little lower than my comfort, but I think, given the overall trajectory, it's not a bad idea to consider a long trade, even from, the current juncture. So Berger Paint with a target of, 630 and a 650 can be considered. Stop loss at 580. One stock that doesn't often get discussed, but has had a very, very good move is AkzoNobel. And this stock has had a practically, vertical rise from 27,800 levels all the way up until 3,900. So this is the one that, we still prefer. Volumes are comparatively lower, to the others. But the move and, the move on this one has been rather steady. And, as I said, continues to, attract attention on the price action at least. So if you want to enter, then your targets on this one would be 4,100 and 4,250. And on the downside, you're looking at 3,700 as a good support zone. So AkzoNobel is the one that I have on my radar from this entire space.
All right. Thanks so much, Chandan, as well as Kush, for joining in today and giving us your thoughts. Really appreciate your time. Well, the setup for paint companies looks good from a technical perspective. Fundamentally, may not be looking too bad either. We are the cusp of, or we are in the midst of the festive season, if you will. Plus, crude prices have come off. Abhijit Roy, the MD and CEO of Berger Paints, must be a happy man. Abhijit, are you? Because, I know crude prices fall doesn't immediately impact. You guys must be having long-term hedges in place. But this doesn't look like a one-off decline. There seems to be a structural issue with global demand, which may keep prices lower. And India, the first amongst equals when it comes to large economies with growth. And we are on the cusp of the festive season. Is this a good, potent cocktail that you can hope for?
Yeah, so good morning. It looks good as of now. For the margin perspective, definitely this will help. The raw material prices have been modest, I would say. In the last few months, it's not been increasing, relatively stable. In fact, it is decreasing in some of the cases. As the crude prices go down, further decreases are expected. As you rightly said, it will not immediately impact across the board. Some of the raw materials will get impacted immediately. Some will come through in the next quarter because we do hold stock of finished goods and raw materials. So that will impact in the third quarter, but some of it will definitely come in this quarter itself, which will boost the profitability.
Abhijit, so this is interesting because it's a given. Petchem crude is a key raw material for paint companies. Would you be able to quantify for us what percentage of raw materials stands to get directly impacted on back of crude price movement?
Well, we haven't calculated in that way, but I think about 35 to 40% definitely will be immediately impacted. The rest will be basically we have some stocks. So, from that perspective, that will carry forward a little bit, into the next quarter. But prices have been dropping in the past as well, so margins will be reasonably decent for the entire paint industry this quarter.
What do you see those margins at, Mr. Rohan? A very good morning to you. This is Tamanna Inamdar here. In Q1, you were at 16.9%, 17% odd. What do you see as the boost to margins as a result of crude directionally being lower most of this quarter?
So this will improve, as I indicated last time also, normally we are in the range of 15 to 17, but this time it will cross that 17% level and will be at a higher level slightly, largely because of the raw material prices softening.
Okay, so a northward of 17%. Anything more specific you would like to add to that?
No, I won't, but it will be definitely better than 17.
Okay. Just want to understand, get a sense from you on, I think, what the whole competitive landscape has been looking like. I think one big factor for your space has been a new entrant. And I'm just wondering if you've seen any impact at all, and if yes, to what extent?
So, the large competitor has been, busy getting the distribution in place. So far, it hasn't impacted us in any significant way at all. We carry on with our business, with our dealers, with our set of painters, architects, interior decorators, builders. It will take time. As I have always maintained, it's a slow and steady process. I don't expect, any major changes happening in the paint industry in the immediate context.
So, Abhijit, your Q1 volume growth was healthy at about 12%. We are looking at 2 quarters of some bit of festive demand coming in, at least in this one, and proper festive demand likely coming in. And most of your peers tell us that paints anyways constitute about 1.5% to 2% of the overall house. So it doesn't really matter too much if you take some price increases too. So I would love to know what's the kind of volume growth that you anticipate, per se, ballpark estimates, and could that be accompanied by some price hikes as well, or you don't foresee the need to take price hikes now?
As of now, there is no necessary impetus for us to take any price increase. We have taken one price increase, which was about 2.5 odd percentage, which we took in the month of July and little bit in August as well. I don't see a need for any further price increase immediately because, as you know, that the raw material prices have softened. So there is no question of, again, taking price increases to offset, raw material price increases. So that's something which is not likely to happen. As far as volume growth is concerned, July was good. August was a bit muted because of the excessive rains across the country, and in rains, that in paint gets affected, especially the exterior paint, gets badly affected. So there were a large number of states, and some of them unusual like Gujarat, which had excessive rains and flood and all, so August was muted, but September looks good as of now, better than expected, possibly a little bit, so we should bounce back in September quite a lot.
12% Q1, maybe a bit of a slowdown in Q2, but Q3 peak festive, you believe mid-teens kind of volume growth possible?
Yes, I think in Q3, the volume growth will come back to, somewhere around that mid-teen level, possibly.
Mr. Roy, you mentioned that you've already taken a price hike, don't need another one because, of course, crude prices are softening. I'm wondering if you'd go in the other direction and pass on some of those benefits to customers specifically because now more competition. Yes, your competitors setting up their distribution, but they'll set it up at some point. Is that something that you have on the table?
No, not really. Tamanna, because these crude prices keep going up and down. You cannot, come to a strategic decision based on current crude prices because something will happen and then the crude prices move up again in the next 1 month or so. So we have to look at stability of the RM prices. It's not only crude but also the demand supply equation which is to be kept in mind. As of now, as someone said, just now, that because of slightly modest demand coming in from China and other parts of the world, I think there is a little bit of softening of RM prices, but it can change. It can change quite a lot. With the changing scenario in the world. So therefore, I don't see us dropping prices just to ensure that because demand is there, and in the third quarter, as I said, it is going to be reasonably good. So there is no need as well for doing that.
It's also Samina joining in. Let's get beyond margins and let's get beyond crude now. Let's talk shop. Of course, you have this big new player in the market, and it's of course not going to do too much damage. But for the interim, you might have to realign incentives, your distributor pack. All of that may or may not impact your margins or operations. What I also want to understand from you, the other way to deal with that is to diversify your portfolio, and of course the different product offerings that you have. So help me with this. Break down your portfolio across decorative, industrial, and automotive paints. What is the growth you're expecting? Where do you think the alpha is going to come from? And also talking about diversification, what about verticals like waterproofing, wood coatings, protective coatings? Because that's the upcoming areas you want to go out and exploit, I would imagine, right?
Yes, you're absolutely right. So though there is a intensification in competition, as you said, little bit, in the decorative side, but there are areas of opportunity as well for us. We are the number 2 player even in decorative and growing market share every quarter. For the last 4 quarters, we have gained market share actually. So in decorative, there is a lot of space for us in terms of distribution network itself. So that by itself should grow at a reasonable pace for us. We are focusing on the urban areas where we have been relatively much weaker, and we have set up a separate team for that. And we are working hard in getting our distribution network in place in the urban locations. And I think, we are getting good positive results already from these markets. The second part is, as you rightly said, in terms of construction, chemical and waterproofing and protective coatings. In protective, we are the leader in India, and we have been a leader in India for the last, 50, 60 years. This is a legacy of our British heritage, and we continue to, have a good position here, and we would like to exploit that because of the infrastructure spends. The demand has gone up a little bit, and we would like to retain our position in the protective coatings and have good growth, incremental growth coming out in that particular segment. The third is, construction, chemical and waterproofing, where we started our journey about 5 years back, but we have moved rapidly. We are in the top 4-5 players in India today. We will be in the top 3 definitely by the end of this year. So we are looking at, accelerating our growth in this segment. The growth rate has been much higher than paints in waterproofing and construction chemicals, and that will be retained by us.
One last follow-up on this, right? So while you as a company cannot control what happens to your input cost to a great extent, because there's also logistic cost that goes in, what you can control is what you set out for Berger to do over the next 1 to 2 years. Now, which product, which market segment is going to be the biggest growth driver for Berger Paints? And also, how significant is the export market for you? Is that a market space you would consider, you look at? Is that a big talking point in your board meetings?
So, it's not significant as of now, but we are focusing on the industrial exports, which we see as a possibility. Possibly a little bit of construction chemicals as well. So these two, it's not so much of decorative paints which can possibly be exported, but definitely industrial, especially protective coatings, where we have a very strong standing in India. we have started looking actively at the export market. So that's one point which we are looking at. In terms of possible growth opportunities, as I said, there are three major ones. One is the decorative in the space of basically geographical expansion, especially in the south and the west, and more so in the urban markets. So that's one big opportunity of growth for us. The second is the construction chemical and waterproofing segment, where India is poised for rapid growth in this segment itself. So the segment growth, and along with that, we have a very interesting range of products in this segment, and I think we should get very good growth out of this particular area.
Okay. Abhijit Roy, we wish you all the best for the festive season, upcoming competition, and more. Thanks so much for tuning in, and all the best with the times ahead.
Thank you. Thank you.
Right. That's Berger Paints sounding sanguine about prospects going ahead. Price hikes taken, no rollbacks. Hopefully margins get back to mid-teens as well. Rather higher than mid-teens, 17% on, and volume growth in mid-teens in Q3. So interesting conversation.
And diversification, I think that's what we want to step out and take a check of, because a couple of these legacy players were hit because of the new entrant entering the market. Of course, one way of doing it is you go out and give longer credit periods to your distributors, but the other way is to build out a portfolio that is going to be resilient to competition only in paints, right? And stuff like a cross segment which goes into home building has become significant for Berger Paints.
Competitive space also.
I think it's a volume game for them.
Yeah, it's competitive, and the unorganized space also has a huge share there. But anyway, moving from paints to now hotels, Sanjay Sethi with us.
Paint hotels.
MD and CEO of Chalet Hotels. Mr. Sethi, very good morning and great to have you here on NDTV Profit. Always a pleasure to speak with you. And, we're catching up at a time when Q1 has not been superb for the entire space, and elections, etc. could be some of those reasons. What is Q2 looking like? Let's start with a bit of a temperature check.
Good morning. Q1 wasn't great because we got spoiled by the increases that we saw in the previous quarters. But having said that, Chalet's Q1 growth on revenue side was 17% compared to the similar quarter last year. And we doubled our profit before tax. So clearly, by no means muted growth. It was a strong growth. Q2, we had given in our earnings call an indication that July looks better than June did. And I think that got executed that way. We are not at liberty to speak about numbers of Q2. But clearly, it's only upwards from here onwards.
In terms of your outlook that you've already talked about, so you're increasing keys by 28% by FY27, all of that is on track?
Yes, in fact, it's probably better than that now. We recently announced the acquisition of a land parcel in Goa, in South Goa, in Varka. It's a beachfront property. That'll add another 170 rooms to the pipeline that we have. So our pipeline now has gone up to about a little over 1,000 rooms, and we operate currently around 3,050 rooms. So between pipeline and operation, we're already in excess of 4,000 rooms now.
Let's talk about the outlook on revenue per room. Summer season is behind us. Global travel has picked up. Do you still expect average revenue per room to continue to go up, even though the base is much higher now than it was maybe 2 years ago, post-pandemic?
You're right. The base is significantly higher than what it was a couple of years back. But, double-digit RevPAR growth or total revenue growth is pretty much on the cards, given that there's a massive gap on the demand and supply, favoring demand. And I don't know whether you're familiar with the numbers, but I'm happy to share some of them on that front. Pan-India, till 2027, demand's expected to outstrip supply by roughly around 260 bips. But that's pan-India. When you look at the cities that we operate in, the bigger cities, the gap's much larger. And within those bigger cities, if you isolate the segment that we operate in, which is largely the upper upscale and the luxury segment, the gap's significantly higher. So overall outlook, because or on the back of the favorable demand and supply arbitrage, we expect the industry to do very well and Chalet to be one of the leaders in that front.
Sanjay, good morning. Niraj here.
Morning, Niraj.
Couple of questions. One is this whole expectation of growth in the second half on two counts. Every note speaks about growth in the foreign tourist arrivals. I'm wondering why is that considered to be a near certainty? And two, somebody was telling me about how the number of wedding dates go up exponentially once the good period starts until May. Do you benefit out of that as well? So both of these, just trying to gauge what demand could be.
Niraj, I'll speak about the wedding part first. Wedding is a big part of our segment, especially in our two very large hotels in Mumbai, the JW Marriott at the airport at Sahar and the Westin at Powai. Both of them are large hotels with large banqueting facilities and lawns. So we tend to gain when weddings are good. And weddings, as you rightly mentioned, are significantly higher in the second half of the year. On the foreigners front, despite whatever is happening in the global space in terms of the geopolitical activity, quarter one, we saw a 30% jump on foreigners coming into or staying with us at chalet hotels compared to Q1 of the previous year. So clearly that's on the upside. And the true season for foreign travel actually begins from October. We are eager to see how that pans out. A lot depends on the amount of seats that airlines create connecting some of these destinations. And that's improved a little bit, but we expect major improvements to come in the next 2 or 3 quarters.
Okay. So the other thing is, so therefore, we've had a year of the World Cups and India being the country which hosted a lot of global countries as well. Part one. Now we're seeing a very active festive season. The bases move up consistently. You still reckon that the medium-term trajectory could be of a 10 to 15% growth CAGR for the industry?
I don't want to put a number to it, but I think we are comfortably in the 10% CAGR on revenues, I guess.
But the numbers may be better as the ARRs, etc., improve and the F&B revenues improve, and therefore EBITDA could be more than 10% as well?
EBITDA growth should be more than 10% because all of us have learned to keep a tight leash on the costs, and I think that's sort of paying off very helpfully over the last few quarters. We expect that to continue for the next few years.
Mr. Sethi, just a little more detail on two things in the pipeline right now, Goa and, of course, Duke's Resort. You talked about it briefly. Just give us a sense of completion of timeline of the Goa property. And is the rest of this financial year a larger focus on leisure?
So, Tamanna, it's like this. Goa's land that we just acquired. It comes with majority of the approvals already in place as part of the deal. So we should be off the ground fairly quickly, say a quarter or two. But it'll take about 2.5 to 3 years to build it out of that. Duke's has been under renovation and expansion for the last 3 quarters. We've opened a very small inventory in the recent weeks. And we expect that by end of December, we'll have the full resort up and going, and will be relaunched as upper upscale / luxury wellness resort. And we see a lot of good coming off that as far as our leisure portfolio is concerned. But then in addition to that, we are adding 130 additional rooms in Bangalore, which should also be ready by December or January this financial year. We are also working on the Delhi hotel, which is roughly 390 rooms. We expect to open that sometime in last quarter of FY26. And then we've got the Hyatt Regency in Navi Mumbai, which will be starting work on immediately after the monsoons. And we expect to add about 280 rooms there, which will take about 2.5 years from now to complete. So all of that is on track. Overall, as I said, 1,030 odd rooms, which are already in the pipeline. But our BD team continues to be very active to look for additional opportunities. And as and when we close some of them, we'll come back to you.
Mr. Sethi, it's another quick question, and I want to move away from hospitality, talk about commercial for a minute. How is that space playing out? Are you anticipating significant growth coming from there? And you also mentioned that you are on an aggressive spree, right? When opportunities show up, you go pick them up. How do you plan to monitor? How do you plan to do this? Any plans to monetize your real estate land bank?
So, there are two questions there. One, we see the real estate leasing doing extremely well in the right locations. And Bangalore and Powai, Mumbai, where we opened the two new assets, we see significant traction on that front. We've got another little short of 1 million square foot that is under construction now at Powai, which will take our total real estate portfolio to about 3.3 million square feet. And we believe that will be the backbone for continuity to counter the cyclicality of hospitality business. So that annuity business gives us a lot of comfort going forward to counter any cycles going forward. On the growth path, we did a QIP a few months back. We raised a significant amount of money, and we I think, have the gunpowder dry for some serious growth opportunities going forward.
Any hints on in which direction that gunpowder will be utilized, Mr. Sethi?
A good journal will never disclose which way the gunpowder is heading to. But yeah, look, it's going to be as per our strategy that we've declared. We'd like to grow the portfolio in leisure to maybe about 20% of the portfolio. In addition to that, we like the big box, big city hotels, so we'll continue to do more of that. And I've already spoken about the office assets, which will be roughly 25% of the total P&L.
Right. Thank you so much. Always a pleasure. We're speaking about Chalet Hotels this morning. And of course, the second half of the year is where the action is likely to begin, with the return of foreign tourists as well. But before we wrap up on India Market Open this morning, I mean, the big story globally was that face-off between Donald Trump and Kamala Harris. Soon after the debate ended, Taylor Swift came and endorsed her bid to the White House. I mean, in the American context, I'm not sure if it moves the needle or not. But anyway, an interesting debate to watch. And here's a slice of the conversation as we leave you on the show. Thank you so much for watching. Stay tuned. Talking Point up next.
If you want to really know the inside track on who the former president is, if he didn't make it clear already, just ask people who have worked with him. His former chief of staff, a 4-star general, has said he has contempt for the Constitution of the United States. His former national security advisor has said he is dangerous and unfit. His former Secretary of Defense has said the nation, the Republic, would never survive another Trump term. And when we listen to this kind of rhetoric, when the issues that affect the American people are not being addressed, I think the choice is clear in this election.
President Trump, I'll give you a quick minute to respond here.
Thank you, because when I hear that, see, I'm a different kind of a person. I fired most of those people, not so graciously. They did bad things or a bad job. I fired them. They never fired one person. They didn't fire anybody having to do with Afghanistan and the Taliban and the 13 people who's were just killed, viciously and violently killed. And I got to know the parents and the family. They didn't fire. They should have fired all those generals, all those top people, because that was one of the most incompetently handled situations anybody has ever seen. So when somebody does a bad job, I fire them.
Well, let's talk about extreme and understand the context in which this election in 2024 is taking place. The United States Supreme Court recently ruled that the former president would essentially be immune from any misconduct if he were to enter the White House again. Understand, this is someone who has openly said he would terminate, I'm quoting, terminate the Constitution of the United States, that he would weaponize the Department of Justice against his political enemies. Someone who has openly expressed disdain for members of our military. Understand what it would mean if Donald Trump were back in the White House with no guardrails, because certainly we know now the court won't stop him. We know J.D. Vance is not going to stop him. It's up to the American people
Vice President
to stop
Harris.
him.
Thank you. Lindsay?
Vice President Harris, in your last run for president.
This is the one that weaponized, not me. She weaponized. I probably took a bullet to the head because of the things that they say about me. They talk about democracy. I'm a threat to democracy. They're the threat to democracy with a fake Russia investigation that went nowhere.
Thanks so much for tuning into Talking Point. I'm your host, Niraj Shah. The markets are absolutely flat, but you would probably take this with both hands relative to what the rest of the Asian pack was doing at the start of the trading day on Wednesday. The surprise move, though, is a negative move or a downtick that we're seeing on the oil marketing companies. I think the big story of the last 18 hours was how crude prices have come off after OPEC has cut forecast and HP, BP, IOC are not trading at the high point of the day, but trading in the red. Remember, though, that the earnings trajectory for some of these counters will be very, very solid over the course of the next few months, unless, of course, retail prices change. The other big story, of course, has been autos. Now, Tata Motors has been a big loser today because UBS has retained the sell rating on the company with the target price of 825. More importantly, BMW has come in and cut their targets on global slowdown factors, which will obviously impact all global car companies, JLR included. Puneet, my colleague, joins in with some highlights of the note on Tata Motors and then maybe a brief update on what BMW has said too. Puneet, good morning.
Hi, Niraj. Good morning. So definitely, negative for Tata Motors and, stock is reacting on this UBS note. Now, this note specifically talks about, the JLR division of the company and how the higher discounts that they're offering now will be a key negative going forward as well. They have mentioned that, the Range Rover Sport has seen a very sharp and a surprise rise in discounts in the month of July globally as well that they've announced. It mentioned that, the company has launched these three models, the Defender as well as the two Range Rovers back in 2020, and over the last last 3 to 4 years, they've seen successful rollouts of the same. But now that momentum seems to have slowed down, and new launches will only be happening in the next year when JLR comes up with the electric vehicles going forward as well. Now they're transitioning away from petrol and diesel completely. So that's one of the key things also to watch out for, that they will have to support growth only through pricing mechanisms going forward. Now order book is another key metric tracked here. It's at a record low pre-COVID. It's it touched the low which it had seen last in 2019 itself. So that's another key thing to watch out for, that the growth momentum hasn't come forward. They have mentioned that average selling prices of their cars also has gone up by roughly 49% compared to 4 years ago, and now they will have to start moderating them going forward as well, because of the affordability factor, as well as customer having a larger choice as well with competitors. Finally, they have mentioned that they wouldn't be surprised to see some discounts on the Range Rover, as well as is currently a near zero levels of discount on one particular model, the top one, and they are saying that they might be seeing on that. Finally, valuations, they see JLR at roughly 7 times price to earnings, and are seeing 10 to 14 times price EV by EBITDA for the CV as well as the passenger vehicle division. Both of them are slightly in the struggling zone right now, and recovery is only penciled in the second half. So overall, slightly negative picture on India business, and JLR, they have mentioned that it's not a good time for the company itself. Back to you.
Okay. Well, Puneet, thanks for that. Puneet, quick 30 seconds. BMW sounded on the bugle of caution as well.
Yeah, definitely. It's a
30 seconds. Yeah,
it's a very big negative news coming in from BMW in Europe specifically. It just highlights and quantifies what they are going through. They have mentioned that they've cut their EBIT margin guidance to 6% from roughly 10% last year. Free cash flow is another thing. It will be roughly at 4 billion euros for the automotive division versus 6.9 billion that they reported in the same time last year. And some Indian suppliers that we looked at, Motherson would be one of the key ones that would be affected, because they have roughly 4,900 odd crores of revenue coming from BMW. That's roughly 5% only for them, but still a big impact compared to others. The other 2-3 companies would be Uno Minda, Minda Corp, as well as Endurance, because they are very big companies having exposure to Europe. They also have joint ventures there. So watch out for these stocks in trade today on the back of this news from BMW. Back to you.
Thanks for that, Puneet. Well, let's get in Rajesh Kothari, MD of Alpha Accurate Advisors, on the conversation as well. Rajesh, great having you. Thanks for taking the time out. And, I'm going to take a leaf out of what's the recency bias in the markets to start off the conversation. On the global front, BMW and some of the other automakers sounding off the caution bells. People are talking about the same when it comes to four-wheeler inventory in India, and what are the kind of discounts on offer during the festive season, something that we probably haven't seen since 2019. Are you sensing, Rajesh, that urban discretionary consumption or urban consumption at large is slowing down? Is that indicative of what could happen to the economy?
Hi, Niraj. I think, Niraj, there are pockets of consumption which are doing extremely well. And there are pockets of consumption which are, I would say, a little bit moderating. And there are, of course, pockets of consumption which are still not yet improving. They are still in the slow lane. I think what is happening is that the Indian consumer, the entire wallet, the spend of that wallet is changing. Right? It is not a macro thing that consumption is slowing down. I think that will be a wrong judgment. For example, if you look at the entire car industry, the premium end of the car is doing extremely well. Right? The problem is that I would say below 10 lakhs or even a little bit on the mid side, but the premium car segment is doing extremely well. If you look at the real estate registrations, they are doing extremely well. And within that, if you look at the premium real estate, it is doing extraordinarily well. Correct? So I think there are basically patterns which is happening. The wallet of the consumer is changing, and a company which are rightly positioned to those wallet, they are basically becoming gainers, because there the profit pool is expanding disproportionately. So I think it's less to do with the judgment in terms of the overall economy, but I think there are pockets which are yet to improve, and there are pockets which are strengthening.
Okay, and right now we're talking just about urban, right, Rajesh? You believe that I'm not even focusing on rural, or maybe you take an overall consumption, because the common belief, Rajesh, seems to be, or the sense that I'm getting when I'm doing these conversations, is that rural is making a comeback and urban is slowing down. You are saying that that's not necessarily accurate across the board.
Sure, you are right. It is not necessarily accurate, because urban, as I'm saying, every pocket, whether it is a rural, whether it is a urban, There are pockets which are doing well. There are pockets which are not doing well. Right? And that keeps changing, right? The wallet share is changing. And that's what is very, very important to understand. Because ultimately, Niraj, please understand, we all need to finally decide which are the companies which are rightly positioned for those profit pool. If you have that kind of a companies, while constructing portfolio, you will do well. If you're on the other side, definitely you will not do well. So macro, broad indicator, I think, there is nothing like that consumption is slowing. Because then what is rural, what is urban, what is semi-rural, what is semi-urban, all are very, 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 very loose terms. I don't think there are any indices by the government which says that urban consumption versus rural consumption, right?
Got it. Okay, fair point. And in fact, well, viewers, companies have also made this point to an extent. While there are broad buckets, but it's very difficult to kind of alienate one versus the other. So in some cases, companies have mentioned that too. So point well taken. Okay, Rajesh, let's talk about profit pools then. Assuming that it's difficult to predict what the markets will do over the course of the next 6 months, because we've been calling and crying wolf about the valuations for a while, but the market has a mind of its own. So let's leave that question out. I want to talk about this argument that you make very correctly about profit pools. And so identify for us, according to you, where are the 2 or 3 or 4 largest pools of profit available over the course of the next 5 years, and which businesses are probably primed to take advantage of those profit pools?
So one is, of course, the energy transition, the green side of energy. That is one of the largest, I would say, incrementally growth perspective is one important segment. Second important segment is a data center related capex. And when you put up one data center, roughly 40% of that cost goes for the electrification. So it means all types of electrifications which gets involved, be it a transformer and so on and so forth. The third important segment is, the HVDC part of the power transmission. One is normal power transmission, like normal consumption, there is a normal power transmission. But then there is a HVDC related transmission, very, very incrementally, significantly high growth going to be into that part of the segment. When it comes to the, say automobile and auto ancillaries, the content per vehicle, the disproportionate increase there, be it airbags, be it sensors, be it automation, be it alloy wheels, and premiumization of that content. When it talks about the consumption side, a company which is can meet the aspirational at an affordable price. There is a huge demand, but at a right price point. And there are only 1 or 2 or 3 companies which can meet those aspirations at that price point. And these companies are growing 25, 30, 40%. They are not complaining about any slowdown, be it rural, be it urban, be it semi-metros, correct? When it comes to the pharma side, the CDMO side of it, the huge profit pool opportunity over the next 3 to 5 years. So there are companies which are rightly positioned, to capitalize on the U-turn on the US companies incrementally spending more on R&D. If you talk about, for example, the building materials, the wires and cable side, over the next 2, 3, 4 years, you will see more growth on wire and cable side. If you talk about real estate, there are pockets where premium segment, not affordable side of it, mid to premium segment is growing disproportionately. That's another profit pool opportunity. If you talk about banking, the housing finance is a one bigger growth opportunity compared to the normal banking trends. For each sector, Niraj, what I'm trying to say is that for each segment, for each sector, you need to do segmentization. And then within each segment, which are the right companies positioned to capitalize on that growth and position your portfolio accordingly will make significant amount of wealth over the next 3 to 5 years.
I'm going to take your real estate point as the last question of this conversation. But before that, the second last point of this conversation, Rajesh, is on something that has become a big talking point, which is the correction in crude prices. Now, a lot of views around how the near-term profitability of the oil marketing companies, for example, will look very solid as a result of this fall, particularly companies which have a lower refining and a higher marketing piece within that. There are 3 names out there, so I'm not going to ask you about stock ideas out there, but just trying to understand, are you constructive oil marketing companies because of this crude price fall, which looks slightly more structural, or would you avoid them? Why or why not?
Well, Niraj, as you are aware, we strongly believe that we should focus only constructing portfolios in the companies where we have some, competence to ability to predict the earnings power, right? So we do not buy oil marketing companies. Generally speaking, we avoid this entire basket because we believe we cannot predict the crude oil. And it's just not about the crude oil. It is also about the tariffs. It is just not about the tariffs. It is also about the government policy of petrol, diesel prices. Now, all these things are beyond anyone's ability to predict. And therefore, we continue to avoid by and large this space. There are enough opportunities available in the market, while people keep talking about valuations going all-time high and all that stuff. But there are enough opportunities in the market, even at the current valuations, where there are companies which are growing 18, 20, 25%. Think of it. India's largest company, correct? I mean, Reliance Industries in AGM, please put a disclaimer, we do want it. In the AGM, talking about the doubling EBITDA in 4 to 5 years. Now, this is one of the largest private sector company in India, is talking about doubling EBITDA. I'm not talking about mid cap, I'm not talking about small cap, I'm not talking about micro cap. So you can imagine the kind of growth opportunity available for many companies is pretty large. It's probably significantly larger than what probably right now market is expecting in their consensus estimate, correct? And that's why probably the market is not falling to that extent because market is looking at their future earnings power. And those are the all new growth drivers. Those are no more traditional growth drivers. And they are growing disproportionately. Those new growth drivers, they are not growing 10, 12% compounded. They are growing 20 to 30% compounded. So if for any company, if that new growth driver is going to become 25, 30, 40, 50% of their business over the next 4 or 5 years, then your overall growth gets higher from 12% to 18%. Correct?
Got it.
And then
Got it.
Nifty valuations, they are still at almost equal to 10 years average valuations.
Okay, well, a constructive note out there. Rajesh, 1 minute because we have a management waiting, but I saved that for the last simply because I heard you mention about companies which are in the mid end of the housing segment, right? Something like that you mentioned, not the premium housing, but the other side. So the company next probably specializes that's Brigade Enterprises. I'm trying to ask you, if you had a question to ask to a company which is engaged in that business, what would that question be? What is it that you would want to know from a company which is doing that, which has increased the base over the last 3 years? What is that one thing that you would want to know from such a management?
For any real estate company, question always is only one question. What is the current inventory and inventory to sales ratio over next 2 to 3 years at the industry level? I'm talking about a particular region. Say, for example, you're talking about Brigade, then we should ask the segment in which they are into. Say, for example, Bangalore, how is the inventory of the industries moving? And what is the pipeline? The pipeline to inventory to consumption, that basically drives the your pre-sales. And your pre-sales moves to your EBITDA over a period of 2 to 3 years. And that's what basically moves your stock price.
Okay, well, from a stock price perspective, that is the most pertinent question that we will ask Pavitra Shankar and some more. But Rajesh, so good talking to you. Lovely talk about the profit pools yet again. We should try and engage into this conversation at a slightly longer level some other time. But thank you so much for joining us today.
Thank you. Thank you, Niraj.
That's the view from Alpha Accurate on pockets. Very constructive, by the way. One of the rare voices which is sounding constructive on markets even now, comparing it to the 10-year averages. But mentioned about the profit pools that exist for companies which are doing this mid-income housing as well. Brigade right up there. They've done a QIP recently, raised 1,500 crores via the QIP. Pavitra Shankar, MD of the company, Johnson, right now to talk about that. Pavitra, great having you. Thanks so much for taking the time out. Niraj here, good morning. Congrats on the QIP. Why this need to raise money at this current juncture?
Hi, Niraj. Good to be back, and thank you for having me. Yes, we definitely wanted to capitalize on the trends that we're seeing in the sector for the foreseeable future, and wanted to capitalize on that by raising money for growth capital, basically. We'll be using this predominantly to acquire land for the residential sector. We feel that this is a great time to be across all verticals, actually, but especially on residential, because the ability to monetize and also to serve the very strong demand that we see on ground is looking really positive.
Okay. How positive? Tell us about the sentiment, because everybody talks about how real estate is a long cycle. You've spoken about this as well, multiple factors out there. How are things on the ground?
So, we've seen already a couple of years of really strong price increase. Despite that, any new launches are pretty much met with a lot of enthusiasm, which you can physically see by end customers. I'll talk about Brigade in Bangalore, Chennai, and Hyderabad upcoming soon, our launch. But basically, we are seeing a lot of end users come to our sites, respond to our digital marketing campaigns, have very serious conversations about, investing in the residential sector. So I think because of that, we are, and also seeing very quick conversions for the kind of units that they want to buy. Right. So I think from that perspective, we're seeing that it is still very solid demand, despite the price increases so far. Going forward, we are also not really expecting to push pricing so much. I think the pricing that we've seen over the last couple of years has been really healthy. The market is in a good place right now, and it should continue to grow in a stable manner without, expectations also being like, you will still continue to see double-digit and very high price increases. That's when people tend to get carried away. So if we can continue to grow in single-digit price over the next couple of years, I think that's really very good. I did hear the previous speaker as well. So I think from that perspective, inventory is at all-time lows across most of the top developers, especially in markets like Bangalore. We specifically have about 4 million square feet of residential inventory left to sell. And if you look at quarters to sell, Bangalore must be one of the lowest, which means of all the inventory that we have available in the city, it is under 4 quarters to sell. So that means it's very much a seller's market, and that's why we're seeing. That's why we're feeling very positive about things.
So, Parita, just for historical context or understanding this properly, under 4 quarters is the lowest since a number of years?
Yeah, a number of years. I would say an equilibrium point is it should take about 2 to 3 years. Okay. So that's about 12 quarters to basically, sell what is coming out into the market. Because I think the model has been in the past that, if a developer can sell whatever is that project's inventory during the time of construction, then that is sort of the best case scenario. Over the last few years, we've seen that sort of really decrease because of the absorption that is possible. End customers are actually willing to buy earlier and earlier in the time of the launch and the inventory cycle itself. So the demand is so much that we are still able to achieve the pricing that we want for each project, even though we're moving the inventory much, much faster than before. And this is a story we're seeing across multiple markets, across multiple developers as well.
Okay. So, Pavitra, tell us what's happening to cash flows thereof. Because, after 2 really heady years, there was a bit of a pullback on the operating cash flow, let's say, for the year at large, and there may be multiple reasons there. But because sales are so strong, since you're saying inventory is also at 4 quarters lows, it's astounding to know that 4-quarter low is probably so low relative to what you ideally have or ideally can have. What's happening to cash flows, and would this fundraise that you've done be the last of the ones, or it's difficult to call that right now?
On the cash flow side, the sales and pre-sales are just are an indicator. They're sort of a leading indicator of what is to come. Now that we have sold, and in many projects, we tend to sell like 50-60% of the inventory within the first 2 quarters itself. So a lot of the sales start to get locked in at pricing that we are happy with. So it's not that we are just trying to monetize as quickly as possible. This is pricing that we are happy with. Basically, once the project starts to get constructed, that is how we are able to raise the payment demands from the customers due to RERA as well. So as the customers make their payments based on construction-linked milestones. So the cash flows should be balanced. In fact, that is why, Brigade has in the past been able to pay off all of the residential debt on across our projects. So we're basically a zero debt on the residential segment. So we can fund the construction with the customer advances while they are also funding, in tandem with the work that is happening. So the cash flows should still be matching. We have done a fundraise because, sometimes when you have land acquisitions, the amounts that are needed upfront are substantial. So in order to sort of be ready for whatever other opportunities that are presenting themselves today, whether it is joint development or outright acquisition, the fundraise was done to have us be prepared for those kind of opportunities that are coming up across our target markets, Bangalore, Chennai, and Hyderabad.
Okay. And for the quarter gone by as well, while reported residential would have looked muted. Annuity fared really well. So tell us about that side now. How strong is annuity looking, and how will you expand the annuity portfolio materially, Pavitra? Trying to, because different peers of yours are following different lines, and all could be great, right? There's no one holy grail. Just trying to understand, how are you thinking about it?
Yeah, so Brigade has always preferred, a diversified strategy across different domains in real estate. We have actually originally were a commercial real estate company for the first few projects before we started getting into residential. That's way back, 4 decades ago. But currently, our annuity portfolio, we have almost 9 million square feet operating across commercial and retail, and it's almost fully leased out. We have very minimal vacancy. One thing I would like to point out here is, despite having at least a 5 million square feet of SEZ space, we have been able to lease that out completely without having to denotify any of it. So I think that's testament to the strength of the kind of products that we're building, and also the preference of tenants to be in our projects. So that's the reason why the annuity portfolio is cash flowing well and should continue to do so, because now all of the leases are basically locked in, and we'll basically be seeing escalations per the lease agreement. So as of now, the portfolio that we have is fully leased. We are looking to build out another 6 million square feet over the coming few years. And we'll basically be doing that across 3 markets of Bangalore, Chennai, and Hyderabad. So there is a lot of positive outlook for the office and retail segment as well. Office, I think, the whole work from home, hybrid, etc., has sort of settled. Even globally, most companies are pretty much back to work at least 4 days a week. Employers want quality spaces where the employees feel happy to be coming into work, all of that. So I think, and absorption on the commercial space as well has been doing very well in the past year or so, and this year again promises to be a bumper year in terms of leasing. So all things considered, the outlook is very good for office. As far as we are concerned, we want to continue growing that portfolio along with the residential segment as well. Based on the kind of opportunities that we'll see, deal by deal, we'll sort of decide whether that's good for office or residential. But that's kind of how we have been growing in the past and how we'll continue to do so in the future as well.
We wish you all the best for that future, Pavitra Shankar. Thank you so much for taking the time out and being with us today.
Thank you, Niraj. It was great. Thanks.
Right, that's Brigade Enterprises talking about their numbers, the rationale for the QIP, essentially growth, bracing for growth opportunities that may come in at a point of time, and the annuity business seems to be doing okay. That stock isn't quite rallying, but I must tell you, what's rallying today in terms of real estate has to be Century Textiles. That stock is up 7% in the session, was up 5% yesterday after buying that Worli land. I think Ambit and some of the other brokerages say that this could be a material upside in cash flows for Century Textiles. So watch out for that one. Suzlon is up in trade. There is strength in Piramal Pharma yet again. So those are a few on the gaining side. The losing side, Oil India and ONGC stand out as the sore thumbs, really. In addition to, of course, Tata Motors, which is the second largest loser on the Nifty 500. It's not often that you see Tata Motors being in the top 3 on the Nifty 500. Sure, on the Nifty, but on the Nifty 500, it's a rarity. This is a big, sharp pullback in the stock price of Tata Motors, and something that people should definitely take note of. A UBS downgrade plus the BMW warning on their sales itself, and may have a collateral damage impact on JLR volumes as well, at least sentimentally, if not actually. That's all that the time that we have on this edition of Talking Point. Thanks so much for tuning in.
Markets extend a muted session of trade. Nifty trades